Today, the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen.
The Fed is not really sure where tariffs are going to land, and when they land, they're not really sure what the consequences are going to be.
Uncertainty has clearly risen. The pain threshold for the Fed is going to be elevated.
We're getting slowing growth in the second half of the year. The question is, what will they do about it?
We're under known unknowns and unknown unknowns. The probability on both bad outcomes has gone up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday as Chair Powell is going nowhere fast.
We don't think we need to be in a hurry. We think we can be patient. We're in a good position to wait and see, is the thing. We don't have to be in a hurry. The economy has been resilient and is doing fairly well. Our policy is well positioned. The costs of waiting to see further are fairly low.
Chairman Powell snapping into wait-and-see mode, waiting to see the outcome of trade talks, waiting to see if the economy breaks. As the U.S. and China heads towards the weekend preparing to negotiate, the president teasing a, quote, major trade announcement with the U.K. for later this morning.
Yes, so do we start getting deals? And it's going to be important to understand what the contours of those types of deals might be in terms of does that 10% threshold get dropped when it comes to some of our closest trading partners? I just want to say, how do we continue after Jay Powell said wait and see 12 times and wait by itself another 13 times? Really, I mean, this is basically, and Blake Gwynn said it perfectly over at RBC, it was the epitome of this could have been an email with just a subject line that said wait and see.
He's got to wait and see the outcome of these talks. Wait and see for 10 a.m. Eastern time when we hear from the President of the United States. Wait and see the content of this so-called trade agreement. Now, I've heard a lot of people say this could be a template for other nations. I want to be very clear about this. This could be the best case. You've got a relationship between two countries that's pretty good, the US and UK. You've got a trade balance that's pretty balanced between the US and UK. And if they are negotiable, the 10% baseline tariff, I would see whatever number they come up with, if they do indeed adjust that number, and that is still an if, I'd see that as a new floor for tariffs. I wouldn't see that as the baseline for everybody else.
That's the reason why people are watching this so closely. It's sort of a question of, can we go below that 10%? Because the UK is the one friendly partner that only had that 10% ceiling or floor, rather, that was imposed upon them. Here's the key question. What are the ultimate goals? How quickly can they move? Is this going to be a contour of some sort of deal? And then what are the negotiating guidelines? Do we get any sense of what that is from this particular negotiation, given that it was most friendly from the start?
The S&P 500 high this morning. Equity futures up. The S&P higher by 1 full percentage point. Coming up this hour, we'll catch up with Stuart, Kaiser of Citi, with the president set to announce a trade deal. Claudia, Sahm of New Century advises on what she calls the Fed's missed opportunity. And Kelsey, Berro of JPMorgan Asset Management with Chair Powell in wait-and-see mode. We begin this hour with stocks rising as President Donald Trump teases a major trade deal. Stuart, Kaiser of Citi writing, equity markets will look for concrete results at this point, with focus gradually shifting to the ultimate level of tariffs. Stu joins us now for more. Stu, good morning.
Good morning. How are you?
Good to see you. For how much longer can the promise of trade deal sustain this equity market rally?
I mean, I've actually been surprised at how well it's gone, to date. I think you both, use the right terms, contours, frameworks, boilerplates. I think that's what the market's looking for right now. And that our view is you take your key trading partners, your allies. If you get a deal with one or two of them, the market's going to extrapolate that out to this is what a trade deal looks like with a key trading ally. And then you have to deal with China, I think, as a second step. I think the news has probably been a little bit slower than you would have hoped with the allies, but probably a little better, at least in the rumor/headline side, than you would have hoped with China. So, yeah, at this point, rubber needs to meet the road. We need to actually see some numbers here because, as I think Chair Powell said, you're in a wait and see. But while you're in that wait and see, you have a tremendous uncertainty shock that's hit the economy. So the longer you wait, the worst thing you're going to see at the end of it. And I think that's how the market's dealing with it.
The risk is we go into an air pocket for the hard data. HSBC this morning pushing back, saying fundamentals remain dire. Negative activity surprises could see risky assets fall quickly. We also remain doubtful that a policy move from the Fed alone, a so-called Fed put, would turn market sentiment around. What's the Fed's place in all this?
I think it probably goes back to what our playbook has been in the past, that if the Fed is cutting to get you out of a tariff crisis, so to speak, then the markets are going to be meaningfully lower by the time they cut, right? So I think, the markets, I think for now are in this holding pattern, trading at a pretty kind of wide range, and they're looking for resolution. They're looking for evidence of how this is ultimately going to play out. But, our view a month ago was you need these trade deals done pretty quickly, because if not, the uncertainty shock hits the economy. And as Chair Powell detailed, the risks in both directions are actually higher than they have been in a while.
I think it's fascinating that at 10 a.m. Eastern, we're going to get this trade discussion or trade announcement potentially with the U.S. and U.K. At 7:02 a.m. New York time, we're going to get an announcement from the Bank of England, and they're expected to cut rates by 25 basis points in response to weakness, in part because of the trade war. It just raises this question, why is that viewed as such a disinflationary shock around the world and not viewed the same way in the United States?
I mean, part of it's, we're the biggest economy, and I think they're hoping that that'll get us out of it. I think second, frankly, is just the data, right? I mean, so far, and part of it's just timing. The employment data, the inflation data actually looks pretty good. The Fed is trying to message something that's fairly friendly. And look at corporate America. 2/3 of companies that reported this earnings season have left guidance in place. So corporate America is also in a wait-and-see mode. I'm not sure that people are, assuming the outcome will be better in the U.S. at this point. I just think they don't know, and it's just sort of a delaying tactic at this point.
From an equity perspective, are people underestimating how much certain companies will benefit from the current regime? And I'm thinking of the likes of Carvana, which came out and actually upgraded its forecast and delivered better than expected earnings. Because guess what? Used car prices have gone up, and they've actually delivered a much higher level of sales. At what point do you feel more positive just because people seem to be discounting some of those tailwinds?
I think that's a great point. Everybody's been focused on the negative. I think the area where we've been most positive, frankly, is growth stocks, those large cap tech stocks that are a little bit less impacted by tariffs and had this massive PE derating. So I think, the trouble coming into this was the companies that might benefit or the more defensive stocks were so expensive that it was kind of hard to own them ahead of all these tariff headlines. They're not as expensive as they were. So I think what you're seeing is people are re-engaging on stocks that are a little less impacted by tariffs. And secondly, the stocks that have just derated so much that a lot of that bad news is frankly already kind of discounted in the price. The problem is the largest market cap stocks are probably not the tariff beneficiaries, which kind of puts you in a really tricky spot from a portfolio allocation perspective.
Are you saying we can play defense with big tech?
Yeah, we are. Big tech / just growth stocks in general, we think are defensive now. The long leg of growth, so to speak, had a 25% PE derating late February into early March. And once you took the positioning and valuation risk out of those stocks, what you're left with is stocks that generate a tremendous amount of free cash flow, have awesome balance sheets, are generating a lot of earnings growth. So we do think growth is defensive again after that PE derating. And frankly, we've seen clients engaging quite a bit to the long side in large cap tech.
Yesterday afternoon was fascinating for all of us sitting around the table. One headline suggesting that tariffs weren't going down. Another headline suggesting that they might. The equity market whipsawed. And I saw one person question whether this equity market was investable right now. And I think it's always investable at a price. And it's the superior American multiple that I want to understand from you whether it's in question right now, given how whipsawed we are, not by fundamentals, just by headline to headline and a ton of policy volatility.
Yeah, I think investable, I think there's probably two things that go into that. One is the relative valuation, and two, what's your holding period? I think if you're a long-term holder and you can engage in these stocks 25% below what you were paying for them in February, and you have a lot of confidence in their fundamental outlook, that part's investable. A lot of the clients we talk to that are trading day to day and week to week, it probably doesn't feel nearly as investable. The PE premium, it's a good question. I mean, the reason the U.S. trades at a premium is because we generate a much higher return on equity, basically, than any other market in the world. So to the extent that relative ROE gap remains in place, then frankly, we should, trade at a bit of a premium. Go back to Walmart earnings, for instance. They specifically kind of called out that we're keeping our numbers in place because we think our price advantage persists even in a post-tariff world. So point being, the tariffs are an issue for valuation, but on a relative basis, is the U.S. sort of still better positioned to deal with that? And frankly, I think the White House believes that. They believe that we're the largest economy in the world and we're a net importer. So we're ultimately going to be better off through this. Again, that's their view, not a Citi House view, but that's what the market's trying to discount, to your point.
Do you think it's overly dramatic to point to the fact that people are not seeing the same benefit in investing in dollar-denominated assets, risk or otherwise, as a hedge because the dollar tends to rise in times of dislocation? Does that type of technical dynamic seem like it's maybe a little exaggerated to you, or do you think there's something legitimate there?
Look, I think some investors are looking at this as a complete regime change in how kind of global markets work, right? So the attractiveness of the dollar as a defensive haven is sort of under pressure because of tariff policy. So I do think that's meaningful, and I think that's why you're seeing gold perform so well, right? You buy gold, you're short the dollar, but you're not long any other currencies. And I think people have wrestled with this idea. Okay, if the dollar isn't the safe haven, what other currency do I want to own? when I have all this tariff uncertainty. And I think a lot of investors are voting with their feet and saying, I don't want to own any of those other currencies. I'm just going to buy gold. So I'm sort of long gold, short dollar. So look, I think it's a reasonable question. I think we don't know how it's going to play out in any way, shape, or form. And that's the uncertainty premium that's in the market right now. And again, it's benefited gold without question.
You know, John started the show with a theme that will continue to be the theme for a very long time, which is how much more does this market need around the tariffs to really get a sense of what the new framework is and to get a real sustainable rally rather than this sort of choppiness. What are you looking for to give you a sense, okay, this is something to buy rather than something to maybe trade if you're an algo, but otherwise just stay back and hope that it'll pass soon?
Look, honestly, I think it's just a lot more clarity. I'm actually kind of a little disappointed corporate America punted and said, 2/3 of them just left guidance in place, because what that means is 3 months from now, we're going to be asking the exact same questions, right? So I think, we definitely corporate America to tighten up, what their view is on tariffs, without a doubt. I think that'd be impactful. And then, again, what you guys, detailed at the beginning is, we need a boilerplate that can be applied to a wide range of countries, ex-China, so that we can really get a sense of how this is going to impact growth. And frankly, that's been our view for a month, is you need deals with these key trading partners to get there. So I think it's I hate to say it's certainty, but more so it's give us some numbers so corporate America can put those numbers in their models so they can update their guidance so that now we have a really honest view of what the risk reward on earnings looks like. And I think at that point, you can pick a valuation level that you can engage with the market in.
We want the rules of the game. And maybe it starts this morning. This from the president this morning. He's hitting the ground running already on Truth Social. Here's another post for you. The agreement with the UK is a full and comprehensive one that will cement the relationship between the United States and the UK for many years to come. Because of our long history and allegiance together, it's a great honour to have the United Kingdom as our first announcement. Many other deals which are in serious stages of negotiation to follow.
What it highlights to me is the desire, even from this White House, to move more quickly and to give those contours in a way that also sets the stage for the U.S. to potentially say to other trading partners, OK, you want to make a deal with us, come to us, and then we'll treat you well. So this is actually one to watch, even though it's the less contentious one. It's the one that might be really important to give you exactly what Stuart was talking about, those contours.
That's the hope of the equity market this morning. Jim Karen and Morgan Stanley writing in. Jim, good morning. The significance of a deal with the UK extends beyond the UK itself. Does this trigger a series of other deals to follow? Once the first domino falls, the rest are soon to follow. That's the hope. I think we do have to caution. This is a unique relationship with the UK, a trade balance that is fairly balanced at the moment. How much difficult will it be for those other dominoes to fall from here?
And when there are a lot of other issues, you're talking about the VAT tax, you're talking about other potential gripes around technology, when you're talking about Europe, and of course China is its own ball of wax. So there's this real question here of how much you can actually depend on this as providing that framework, that rubric, that concept.
Stu, just to finish with you, on this note, just for now, how much easier will it be once the first domino falls? Or do you still see a lot of sticking points with some major trade partners?
It'll be positive for risk. But I think what Lisa mentioned is very important, which is non-tariff trade barriers, which are really, really hard to negotiate, right? It's very hard to negotiate, employment or labor law. It's very hard to, negotiate something like a VAT tax. So it is going to be positive because the market will extrapolate it. But, to your point, this is a unique case. I think they're all unique cases with their unique moving parts. So the market will probably, react very positively to this news and then probably take a step back when they, have to deal with all those issues.
Stuart Kaiser of Citi is going to sit with us for another 15 minutes or so. Equity markets right now, session highs by a little more than 1% on the S&P 500. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg Brief. President Trump will make a trade announcement this morning. He posted on Truth Social. This should be a very big and exciting day for the United States of America and the United Kingdom. Press conference at the Oval Office, 10 a.m. Eastern Time. The wait for the next pope will continue after black smoke poured out of the Sistine Chapel chimney once again. Cardinals failed to reach an agreement after 2 new rounds of voting. 2 more rounds will happen later this afternoon. And finally, ARM Holdings shares falling in the pre-market after the chip design company gave a disappointing sales forecast for the current quarter, fueling fears of a tariff-driven slowdown for the industry. ARM also said it would not provide an annual target due to uncertainty. And that right there is your Bloomberg Brief. Up next on the programme, a so-called major trade deal.
We're going to put very fair numbers down, and we're going to say, here's what this country, what we want, and congratulations, we have a deal. And they'll either say, great, and they'll start shopping, or they'll say, not good.
Up next on the programme, we'll catch up with Bloomberg's Annmarie Hordern down in Washington, D.C., and you'll hear more from Stu. From New York City, good morning. Equity futures near session highs on the S&P 500, up by 1 full percentage point on the S&P as we look out for the details of a major trade agreement between the US and the UK. Under surveillance this morning, a so-called major trade deal.
We will sign some deals, but much bigger than that is we're going to put down the price that people are going to have to pay to shop in the United States. Think of us as a super luxury store. We're going to put very fair numbers down, and we're going to say, here's what this country, what we want, and congratulations, we have a deal. And they'll either say, great, and they'll start shopping, or they'll say, not good.
Here's the latest this morning. The President will announce a trade agreement with the UK at 10 a.m. Eastern Time. The President teasing the announcement on Truth Social, calling it major and saying it's the first of many. Joining us now from Washington, Bloomberg's Annmarie. AMH, let's get to the details. Have we got any idea of the substance of this agreement?
Well, this is just an agreement. Remember, trade deals take months or years. So memorandum of understanding, that's almost what this is going to be like, even though they want to call this a deal. Here is the details that you need to look out for. What the United Kingdom wants to see from the United States is a cut of tariff quotas on things like steel and the car industry. That is incredibly important for the Prime Minister, Keir Starmer. What the U.S. would like to see the UK have is a lower tariff rate on U.S. cars going into the United Kingdom. And also potentially we can see a cut to the digital services tax, which we all know has been a thorn in the side of UK tech companies for years. So those are the two big parameters I would be looking for going into this 10 a.m. press conference with the president. But we should really caution. This is going to be an outline, a blueprint of potentially a more comprehensive agreement down the road.
Annmarie, how much is this really a template for other agreements with other types of trading partners versus kind of an anomaly given the special relationship that the UK and the US have?
Well, I would say two things on this. One is that there is this special relationship. And you remember in early March when the Prime Minister came to the White House, he came with that what he called unprecedented second visit invitation, a state visit from King Charles. He touched President Trump on the shoulder and said, this is unprecedented, this is very special. And we have seen the Prime Minister really try to fortify a warm relationship with the United States. Remember, the UK has been trying to get this deal done since Brexit in 2016. The second thing I would say for the United States, it is important because of Europe. They are trying to potentially make it harder, put some pressure on Brussels. So what do? You go out, you get an agreement with its neighbor to the north, the United Kingdom. And also, the Treasury Secretary Scott Bessent is traveling to Switzerland. And we're all talking about the fact that he's going there to meet with his Chinese counterparts. But he's also going to be meeting with the president of Switzerland. So right now, what you see the United States doing is getting two countries in Europe to potentially get over the finish line in some sort of trade work agreement without Brussels on board just yet.
Annmarie, appreciate the update. More from Annmarie later on this morning. I think this is part of the criticism on Chairman Powell yesterday in the news conference that he chose to emphasise the risk of the worst-case scenario, higher inflation, higher unemployment, lower growth. And we said in the news conference just after it that there is a best-case scenario here, that maybe the tariffs come down, maybe the deals start to flow, maybe the economy improves. And the chairman didn't really entertain that in any way, shape or form through much of that news conference.
Yeah, Mohamed El-Erian has been talking about maybe a 50-50, 60-40, then 70-30 kind of chance that it could be, it could be bad, but it could also be really good. And how does that change their viewpoint? Is that inflationary? Is that disinflationary? Is this putting them back on that soft landing scenario? If they're going to give a sense of what their response function is, scenario analysis is going to be key. And they stepped away from that and said, absolutely, we are not going to say anything. And we are successfully going to filibuster this entire meeting.
It drives me nuts. Politicians do it too. We won't engage in hypotheticals.
Right.
OK, if you're presented with that by a central banker, this is the follow-up. Can everyone just follow? If they say we won't engage in hypotheticals, the follow-up question is, how do you communicate your reaction function without engaging in hypotheticals? You can't. And your job as a central bank is to explain your reaction function. I don't want your forecast. I don't really care. I can lean on Stu and Andrew Honhorst for forecasts. I don't need that from the Fed. I want to understand how they'll respond to incoming information. And yesterday, sorry for being a little bit harsh, yesterday I think they did a pretty lousy job of explaining how they'd respond to incoming information.
Yeah, I mean, I think another question could be, what would make you hike rates? Is there anything out there that would make you hike rates? Because potentially there could be inflation with growth. And oh, by the way, can't you see yourself in a scenario where tariffs go down and suddenly it's this sort of soft landing nirvana that we'd all been talking about? How do you game that out and understand what data to look at and how much? Instead, they said, you know, we look at models, we look at data, we put them together, we take them apart. We put them in a box. We take them out of a box. We're still talking. That was sort of how it felt.
Governor Waller was clear-eyed a few weeks ago. He's like, if the labour market gets bad, we're cutting interest rates.
Right.
And maybe quickly.
Yeah, well, I mean, in fairness, and this is in fairness, there is the challenge of if inflation is high, and it has been high for this type of time, do they have to wait longer in order to allow the economy to break so that inflation does come down so it doesn't turn into a 70s type of scenario? That is the worst case scenario, and that is clearly the shadow that seems to be hanging over this Fed.
Jobless claims later this morning, 231 the previous number, 241. 230 is the estimate this morning. Stuart, I want to bring you in. How would we react to a higher jobless claims number if at the same time you're getting trade deals? Do you ignore the weakness or do you start to worry that a process has started?
At this point, I think the trade deals probably outweigh, the economic data, like tactically in that way, because I think what the market will say is, well, yeah, we got a little rise in claims, but if these deals get resolved, then anything on a growth perspective for the market would kind of be a transitory growth slowdown, and we'd respond to that. So, I mean, right now, tariffs are kind of driving the bus, and I think for the Fed, growth is more important than inflation right now. So you're kind of like balancing these two things.
You're convinced they can respond to a turn down in growth?
Well, I just think if they have to rank their priorities right now, I think growth is the higher priority. They can respond. Can they respond enough to overcome a massive global trade war? I think that remains to be seen. But to your point, most investors are looking at the market through risk-adjusted returns and probabilistic outcomes. So if the Fed is not offering you any additional information on the probabilities of these outcomes, I mean, they could lay out 3 outcomes, but then you have to assign probabilities to each of those, right? So it's a multi-layered thing, and I think the Fed does not want to get caught in that mousetrap. So they've just decided to kind of stay away from all of it.
There are some questions with some tangible answers, which is how much pain has already been done, how much companies already have to bring down some of their estimates for profitability as well as sales and have ships that might not be coming from overseas. Do you think that is enough for the Fed to have seemed more concerned about a weakening in growth, or do you think that also has been overplayed because of the upsides in a number of companies as well?
I mean, I think they're paying attention. They talk to corporate America. But as I mentioned, 2/3 of companies have kept, guidance where it was. About 16% have cut that guidance. Those stocks have gotten sold off when they've cut guidance. I think the Fed will be very aware of that. But I think corporate America and the Fed are both in wait-and-see mode at this point, and they're sort of in largely in agreement on it. And frankly, look, we haven't seen a huge uptick in claims. We haven't seen a massive rise in the unemployment rate. We haven't seen a particularly big move in inflation. This is a soft data issue right now, so it's sentiment. And I think Chair Powell yesterday tried to say there's a somewhat loose relationship between that soft data actually translating through to a slowdown in hard data. And that's why I think they're being conservative. The fact is you could turn survey data like that, right? I mean, if you get these trade deals, survey data is going to immediately, shift higher, which is why I think they don't want to, step in front of that bus right now. They just want to let that bus go by and figure it out, just because, the survey data, A, is with a lag on hard data, B, with sort of a somewhat questionable relationship, and C, it could be different 2 weeks from now if you get a lot of trade deals.
Stuart, Kaiser at Citi. Stu, good to see you.
Thank you.
As always, thank you, sir. We're all in wait-and-see mode, waiting to see what happens at 10 a.m. Eastern Time. The tease came from the President a little bit earlier this morning. The agreement with the UK is a full and comprehensive one that will cement the relationship between the United States and the United Kingdom for many years to come.
And the reason why this is so important to market participants is potentially it is the first such framework that can give a sense of what future deals could look like, as well as what approach this White House takes to these negotiations.
Up next on the programme, we'll catch up with Claudia Sahm of New Century Advisors on the Fed's wait-and-see approach. Equity futures on the S&P positive by 1 full percentage point. Live from New York, this is Bloomberg. the prospect of a full, comprehensive trade agreement between the United States and the UK to be announced at 10 a.m. Eastern Time, the details of which could move this market one way or the other. The hope is that this is the start. The dominoes fall from here in a positive way and more deals come. Equity futures at the moment positive by 1 full percentage point on the S&P. On the Nasdaq, up by 1.4. On the Russell, up by 1.5. With 3 hours until the cash open, with your morning movers is Danny Berger. Hey, Danny.
Hey, John. The other piece of news coming out of the White House that lifted chip makers specifically yesterday and continues to today is that the Trump administration plans to rescind Biden-era AI chip restrictions. It's going to replace it with something. We don't know what that something is yet, but the optimism continues. NVIDIA immediately turned around yesterday and jumped 3%. It is still up another 1.8% this morning. Not all chip makers are created equally. ARM reporting earnings. The chip designer out of the UK, shares falling nearly 9%. It gave a disappointing forecast for this current quarter. Now, it just blamed the timing of contracts with new customers. But this is a market just given by the sell-off that believes it might be more pernicious than that it might have something to do with demand, especially in this uncertain environment. So shares are down this morning. Now, the final stock, Lisa, you mentioned this one, Carvana, a really solid set of earnings from the used car dealer. Profit doubled. It also saw record vehicle volumes, and at the same time, its loan sales went up too. Now, there's this idea that there's been a pull forward. Cars are going to get more expensive because of tariffs, but the CEO saying that this is something that might last, because if new cars are more expensive, more people will be turning to marketplaces like Carvana for used cars. So those shares up just under 6%, John.
Danny, appreciate it. 3 of the movers in the pre-market. Danny, thank you very much. More from Danny in the next hour. On our radar this morning, our top story, President Trump announcing he's made the first of many trade deals. Trump posting on Truth Social, this should be a very big and exciting day for the United States of America and the UK. The press conference at the Oval Office, 10 a.m. Eastern Time. 3
major questions, in my opinion, around this particular announcement, other than just what the contours of this looks like. Will the 10% baseline stick? If it doesn't, does that mean that there's actually a new floor in terms of, or new ceiling for how high tariffs necessarily will be? Second one, with our movies. A real question here around the ban or the extra tariff on movies coming from overseas, given the fact that the UK is actually a significant source of movies of where they are filmed from the United States. And the third one is, how does this complicate things for the Bank of England, which has to act 3 hours ahead of this announcement at a time when there is a great deal of uncertainty around what the future of trade agreements will look like?
I think they were going to cut rates anyway.
Of course.
I mean, we'll find out what the UK does a little bit later this morning. You said movies. I'm thinking autos. This isn't the only bucket of tariffs that we've got on at the moment. It's not just about the 10% baseline. You've got tariffs on steel and aluminum. You've got tariffs on autos. And the auto piece of this is going to be so important for other countries that are in the line for trade deals. Japan, South Korea. Annmarie has talked about this a lot. It goes beyond just that 10% line in the sand.
Yeah, that has to do with what other tariffs there are in place. I just wonder again, and we have to keep going back to this, how much the UK is a template for other countries, or whether some of these sectoral tariffs will selectively be taken out for certain countries and not for others. It is so confusing to get your head around this, which is the reason why people are just looking and hoping that maybe we get some more clarity.
Heading into the weekend for negotiations with China. China reiterating this, calling for the US to cancel unilateral tariffs ahead of the weekend's trade talks. This coming after President Trump said he's unwilling to lower levies in order to jumpstart negotiations. Both of them playing hardball going into Switzerland.
Yeah, hard to know how much is noise and how much is signal in terms of what this means about just even coming to the table and de-escalating some of the pressures. I also am struggling to understand the so-called AI diffusion rule that President Trump got rid of, the Biden-era chip restrictions that really prevented the likes of NVIDIA from selling chips not just to China, but other trade partners above a certain level because they didn't want those chips making their way into China. A real question here, is this an easing in the pressures? Is this not? Again, such a lack of clarity, not only in the signaling, but also in terms of just what the contours of some of these restrictions are going to be.
Try to run a business in this environment. It's difficult, particularly for the car makers. Look at this. Toyota forecasting a $1.3 billion profit hit from tariffs in just 2 months. Ford raising its sticker prices on Mexican-made models by as much as $2,000 after saying it expects a $2.5 billion hit from tariffs this year alone.
So last week, Jim Farley, the CEO of Ford, came out and said they're not going to necessarily raise prices right away. They have to watch what competitors do before they understand exactly how much consumers are willing to absorb some of those costs. And then, in a memo seen by Bloomberg, it was apparent that they were increasing their car prices by as much as $2,000. What does that tell you? These are ones that are made in Mexico. They have extra costs. They are teasing the market, and they are going to tease the market probably with things that are higher price vehicles where they have more give. And you can start to see this play out in a market in real time, which is the reason why I'm watching CPI next week, which is the reason why inflation reading is going to be so important, because it could start to creep in as soon as the next few weeks.
The president is teasing Chairman Powell at the moment. I think we've got this post ready for you. Let's bring it up. Too late, Jerome Powell is a fool who doesn't have a clue. Other than that, I like him very much. Oil and energy is way down. Almost all costs, groceries and eggs are down. Virtually no inflation. Tariff money pouring into the US. The exact opposite of too late. Enjoy.
What this signifies to me is that somebody told President Trump to tamp down the rhetoric around firing Jay Powell. And this is almost downright an endorsement because, frankly, considering the termination concepts that you had before.
Is that how low the bar is?
That's how low the bar is, yeah,
You're
absolutely.
saying this is him playing nice?
100%, absolutely.
Okay.
Because
All
this
right.
is essentially trying to make the argument the economy is pretty good. You know, he's going to do what he is going to do. I like him. And oil, you know, check it out.
I guess everything's relative.
I mean, am I wrong?
This is the president playing nice, yeah. Relative to firing him.
Exactly, 100%.
Sure, anything's nice relative to terminating his contract.
You know, he didn't say, well, he said a fool, but whatever.
OK, that's the latest from the president. As Lisa mentioned, the Trump administration planning to rescind and replace some Biden-era AI chip curbs. Officials looking to offer opportunities for some countries to negotiate their chip access. Bloomberg's Tom McKenzie joins us now from London to explain all of this. Tom, welcome back to the programme, buddy. I think we have to start with the so-called diffusion rule. Let's start there.
Yeah.
Just explain what that is and why the president doesn't like it.
Yeah, the diffusion rule, or the traffic light system, where you have US allies, so you can think of the UK, Australia in one bucket, the green light. Those in the middle, those neutral countries, that's amber, of course, so the likes of the UAE and Saudi Arabia, and then, of course, the adversaries of the US, so China and Russia in the bottom bracket. They do not get access to the most high-end AI accelerators. Those at the top bracket, of course, and the green light do get those free access, and those in the middle get a restricted list. They have to apply for licenses, and they get a restricted number per year. That rule set to kick in May the 15th. As you say, they are now looking to repeal that law. They haven't done it yet, but they're not expected to enforce it if it kicks into place. The timing is really interesting because it comes ahead, of course, of Trump's visit to the Middle East, to the UAE, to Saudi Arabia. And we know those countries have been very angry about this Biden-era restriction. We know as well, corporations like NVIDIA, Jensen Huang has been very clear about the impact of this rule, as has AMD as well. So there's been the corporate pressure and, of course, on a national state-level pressure on Washington to adjust these rules. The debate is still there. This is not about easing up the pressure on China. The focus is still on those third-party countries that some say have allowed the shipments of some of these top-end AI accelerators into China. Think Malaysia, think Thailand.
Yesterday, we saw NVIDIA shares up more than 3% on the backs of this. This is what the Commerce Department had to say when there was this potential repeal of this diffusion rule. The Biden AI rule is overly complex, overly bureaucratic, and would stymie American innovation. We will be replacing it with a much simpler rule that unleashes American innovation and ensures American AI dominance. Tom, would this rule be more black and white, just a red light and a green light, like Scott Bessent was saying yesterday, and actually more stringent? Do we have any sense of what that could look like?
Yeah, and Jensen Huang as well, NVIDIA putting out a statement saying they welcome this change. And we're still waiting for what the details will be. But it seems like it could be another tool using these AI accelerators by NVIDIA, by AMD, another tool in Trump's arsenal when it comes to these bilateral negotiations with countries. If you are the UAE and you commit to over $1 trillion of spend on infrastructure in the US, does that open the door to having more access to these AI accelerators? The same conversation around Saudi Arabia. Arguably, that's the way to look at it. This is another tool in the arsenal of President Trump. Whether it makes it less complicated, I think, is a key question. The assessment from some is that, in fact, it will become more complicated, more difficult for these companies to navigate around this. And a reminder, of course, Howard Lutnick has said he's going to take a tough line in terms of AI accelerators into the Chinese market, particularly on the back of DeepSeek. And, of course, we saw NVIDIA writing down, $5.5 billion when the H20 chip that they designed specifically to get around those curbs was also blacklisted by the Trump administration.
Hey, Tom, appreciate the update. Thank you, sir. Tom McKenzie over in London. NVIDIA this morning positive by 1.65%. We are all in wait-and-see mode, including the Fed chair, Jay Powell. Claudia Sahm of New Century Advisors writing the following: I agree with the Fed's decision to hold rates and flag the risk of higher unemployment and inflation. However, it was a missed opportunity to lay out how it plans to decide whether tariff-induced inflation is temporary. Claudia joins us now for more. Claudia, welcome to the programme. Let's build on some of that. What would you have liked to hear specifically from the chairman in that news conference?
I'd like to hear their framework, what kind of data they're looking at, how they're going to move back into some forecasting, right? Like what is it they're going to use to, it's clear that the Fed, or at least Powell they're not embracing this. It's the textbook case. Inflation, when it's because of tariffs, it's temporary. Now, we do hear Governor Waller making that case. We got to be brave and it's temporary. We need more than that, right? Like, what are they looking at in the data? And this is where I think looking more broadly, not just the CPI, the labor report, but how are they using all these surveys of businesses, the surveys of consumers, that soft data that seems somewhat maligned. Like, what are they going to use to make that decision? And I know that they must be doing that work. It's just, I think sharing more of that before we actually get to the position where the dual mandate is in conflict would really be helpful as a guide.
Claudia, do you agree with Fed Chair Jay Powell that there isn't that big of a cost to waiting?
The Fed's tools work with a lag. So there are costs to waiting. Now, I agree that at this moment, it's too fluid, right? And this is a historic shock that is facing the economy, and businesses are just starting to work through it, and it could go in a lot of different directions. So again, I understand why this is a moment where, holding makes sense. And yet, there are costs to waiting. And I think one of the issues I really took in the press conference was Powell, reinforcing, well, but the data are fine. The inflation's fine, the unemployment's fine. The data are not fine, right? If we look at, say, into the first quarter GDP, that surge in imports, that is telling us this is a really big shock that's coming at the economy. This is out of expectations. Businesses are pulling in, rushing imports, probably building inventories. That all comes at a cost. And remember, what we thought in the first quarter was going to be the tariff increase, it's actually worse now. So, it's already here. People are changing behavior. No, it's not in CPI. No, it's not in the unemployment rate yet, but it's coming. So, prepare. You can wait, but you really need to be prepared.
There was another aspect of this press conference that I found particularly interesting, and it was when Fed Chair Jay Powell said that the 2024 rate cuts were not preemptive. If anything, it was a little late. And of course, this is referring to the unemployment rate that had increased by 0.5 percentage point, as the Sahm rule dictates, your rule. And they did respond. And then some of that data was revised upward, actually. What did you make of that comment that, if anything, we were a bit late?
I don't think they anticipated going straight up with 50 basis points. I think the 50 basis points was a catch-up that they should have started one meeting earlier. I think that's the late. And it's because they weren't reacting to the bottom falling out. It was we don't want to see further weakening. So I think the Fed probably would have preferred to have had that in, more spread out in 25 basis point increments. But I think that's where it came from. But that's such a fine point on timing. So I can understand why that's seems a little muddled.
I think it's important to go back over it, though, Lisa. I'm pleased you brought it up. We've had so many guests say this Fed is willing to be late, and we're all struggling to define what late is to the Federal Reserve. If last year was late, I think the market would take that. Is that late? 100 basis points in the summer, little drift higher in unemployment.
Yeah, if that's late, that is the most dovish message you could possibly send, because that means that being late means being on time for a lot of other people. That seems to be my take.
Claudia, you're one of the best, always clinical. Appreciate your time. Claudia Sahm there of New Century Advisors on the inflation situation. Claudia's right. The effects on inflation could be short-lived. The effects on inflation could be more persistent. Heard that from the chairman yesterday. How will they know? How will they know the difference between the two? At what point? How long does it take to find out?
When do we get a sense of their reaction function, to your point of view? It was interesting, as Bob Michael pointed out, that the transitory word seems to have been retired. At least it's been packaged back up and put back on the shelf. It was not repeated yesterday. Wait and see is the new word of the day. And it seems like they are not willing to commit to believing that it is going to be something that only will be a passing trend.
It's got a new wrapper.
Yeah, what is it?
Short-lived.
Short-lived?
Yeah, not transitory anymore.
Think so? I think it's just wait and see. Honestly, I keep going back to this Blake Wynn email. I learned this note that he wrote where he said the epitome of this meeting was the epitome of this could have been an email, which was just a subject line that just said, wait and see.
We've seen that a million times. Wait and see, wait and see. We've got to wait and see. Let's get you some stories elsewhere this morning with your Bloomberg Brief. Here's Yohara Anand. Hey, Yohara.
Good morning, John. President Trump continuing to criticize Fed Chair Jay Powell for not cutting rates. In a post on Truth Social, the president calling the Fed chair too late and saying he doesn't have a clue. Trump went on to say, other than that, I like him very much. Meanwhile, HSBC is offering a new loan product to U.S. companies struggling to cover the costs of President Trump's tariffs. The bank says it's extending its TradePay platform to directly cover the cost of increased expenses involved in shipping products into the U.S. And the Champions League final is set after PSG eliminated Arsenal. PSG sealed a 3-1 aggregate win in front of the home crowd and now has a chance for redemption after the heartbreak of the final 5 years ago. They'll be facing Inter Milan at Allianz Arena in Munich. The match for the trophy is set for Saturday, May 31st. That's your Bloomberg Brief. John?
Very, very cool. Looking forward to it. Yahara, thank you. More from Yahara in the next hour. Up next on the program, the Fed's new motto.
For the time being, we're well positioned to wait for greater clarity. We await further clarity. Waiting to see further, we have the ability to wait and see. That's why we're waiting.
That's why they're waiting. Kelsey Berro of JPMorgan Asset Management weighs in next. From New York this morning, good morning. A statement from the President of the United States already this morning saying the following: engaging in talks with the UK and writing this. The agreement with the UK is a full and comprehensive one that will cement the relationship between the United States and the UK for many years to come. Because of our long-time history and allegiance together, it is a great honour to have the United Kingdom as our first announcement. Many other deals which are in serious stages of negotiation to follow. And that's why this market is trading near session highs. On the S&P 500 right now, on the S&P we're positive by 1 full percentage point. On the Nasdaq, up by 1.4. We've all got to wait and see. Under surveillance this morning, it's the Fed's new motto.
For the time being, we're well positioned to wait for greater clarity. We await further clarity. Wait and see. Wait and see. Waiting to see further. Wait and see. Wait and see. Wait and see. Waiting to see. We simply have to wait and see. We'll just have to wait and see. We have the ability to wait and see. That's why we're waiting.
That's why he's waiting. Fed Chair Jay Powell saying the Federal Reserve is positioned and committed to a wait-and-see approach. Kelsey Berro of JPMorgan Asset Management writing this: we expect the Fed to look through tariff-related inflation so long as it is perceived to be a one-time price level reset, but this will take time to determine. Kelsey joins us now for more. Kelsey, good morning.
Good morning.
That's my question. How long does it take to understand whether this is short-lived or persistent? What defines that?
Yeah, it's a difficult question, and Chair Powell was asked that exact question, and he didn't give a lot of guidance on that. I don't think he ruled out a cut in June, or I don't think he ruled out really anything. He created max optionality for himself, which he's become very good at doing. I mean, if anything, I look at the reaction of the bond market to the meeting, and I think it's spot on exactly what he wanted, which is very little movement at all. So kudos to him. Let the policy and the shifts in policy drive the bond market, not the Fed right now, because just like the market, the Fed is waiting for more guidance on what's coming next.
Let's build on that. You went to the bond market. What's its signal about that debate about whether it's short-lived or whether it's more persistent? There are different ways to gauge inflation expectations, survey methods, market-based expectations. What's the market signaling?
To us, it's pretty clear. The market is signaling that this is going to be short-lived. And the repricing within the inflation market, tips, break-evens, as well as inflation swaps, has been very efficient. Efficient meaning that the inflation impact is really concentrated to the next 12 to 24 months. And then beyond that, you're seeing very little impact. If anything, the market is pricing in a probability that beyond the next 12 to 24 months, inflation actually falls below target. Because ultimately, what we're thinking about here is, what are tariffs ultimately? They're a tax on the consumer. They reduce demand. And ultimately, that's something that weakens the economy, weakens prices, not the other way around.
I'm looking at the cuts that other central banks around the world have made since the middle of last year. The ECB, 175 basis points. The Bank of Canada, 225 basis points. After this morning, the expectation is the Bank of England will have done 100 basis points like the Federal Reserve. Is there a world in which it could be disinflationary, these tariffs, for the entirety of the developed world, but not the United States?
In the short term, probably, but in the longer term, I do think that you are going to see the negative demand impulse overwhelm the short-term impact of tariffs. But I think it's really interesting what you just said, highlighting that other central banks around the world are continuing with their easing policy. I was just checking before I came on today what the return on the global bond index is year to date. So the U.S. Ag is up about 2.5%, pretty respectable given the volatility, so still working as a diversifier in your portfolio. The global Ag is up 5.5% year to date. Right? I think people really underappreciate that there's quite a lot of opportunity outside the U.S. in terms of developed bond market, government bond markets. And also, other central banks, the trade-off is much less ambiguous. It's much more clear. Both the growth aspect and the inflation aspect are telling them to continue to cut rates, which is what we expect the BOE to do at 7 a.m.
This is the reason why the wait and see for Fed Chair Jay Powell is a reason that a number of investors around the world are increasingly looking elsewhere other than the United States, because wait and see is not a good strategy for investors in a lot of ways. Steve Major over at HSBC said this morning, we prefer taking duration exposure in the U.S. and stay neutral on U.S. Treasuries as they wait for some of the policy uncertainties to subside. Do you agree with that? Is that kind of what you're thinking?
Yeah, so I would say in general, I think longer dated yields are somewhat range bound here. We've had a range for the 10-year Treasury of around 375 to 450. So we're on the higher end of that range. And what that means is that there is some asymmetry there. For example, if we did see an increase in initial jobless claims at 8:30 this morning, we would expect, there is significant room for yields to move lower, for the market to price in a more aggressive Fed cutting cycle. But in the near term, I think that the market has been fairly stable. It's been consolidating in a narrower and narrower range. And ultimately, what's going to break us out of that is going to be an indication on policy, whether it be fiscal policy or trade policy. I think that one of the things that is going to become more of a focus, so far, trade policy, we had the escalation aspect of it, and then when is the escalation going to stop? We got peak escalation, then we are on the de-escalation train. What I think people need to start focusing on is where are we going to end up? What is that effective tariff rate that we're going to settle at? The negotiations today with the UK are going to do essentially nothing to change that effective tariff rate. It is still on track to be extraordinarily high. So while maybe this is good news, I'm not necessarily sure it's a roadmap for the rest of the world. And really what will be driving sentiment in the market as we turn to the next week will probably be more likely the negotiations with China over the weekend.
Kelsey, appreciate the update and the reaction. Kelsey Berro at JPMorgan Asset Management, framing things, I think, quite well. If the first deal is with the UK and we expect the announcement at 10 a.m. Eastern Time, it will be the easiest deal compared to, say, China and the negotiations over the weekend.
Which is a reason why potentially the rhetoric around the talks about talks might end up being more important.
The second hour of Bloomberg Surveillance up next. We'll catch up with Gargi Chaudhuri of BlackRock. More from Annmarie down in Washington, D.C., Nouriel Roubini of NYU Stern, and we'll speak to the former Kansas City Fed President Esther George from New York City this morning. Good morning.
The tariff increases announced so far have been significantly larger than anticipated, and their effects on the economy remain highly uncertain.
How do they assess then what the impact of tariffs will be on the economy if they don't have the tariff rate?
The probability of recession has gone up. I don't think, anyway, that the Fed's going to be cutting to try to get ahead of that.
Our recession scenario is 60%.
The whole theme everybody's been talking about, and Powell answered in multiple ways, is we don't know, and he doesn't know, and it's heightened uncertainty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Equity markets right now, your scores look like this. Live from New York City this morning. Good morning. The second hour of Bloomberg Surveillance starts right now with equity futures on the S&P higher by more than 1 full percentage point. That's the S&P on the Nasdaq up by 1.5. The Y, plenty of Ys, but the main one is this one right here. The President of the United States teeing up 10 a.m. Eastern Time. The agreement with the UK, a full and comprehensive one that will cement the relationship between the US and the UK for many years to come. And the hope of this market, it's the first of many.
And it sets a template of some sort in terms of how far the U.S. is willing to go to negotiate and bring down that 10% floor potentially for tariffs. Raises a question, how much is it actually a template, given that it actually has a pretty good relationship between these two? Nonetheless, it is important to see the very first of trade deals at a time when President Trump says there are many to come.
And if I'm a trade partner looking at how this is playing out, I want to know what is negotiable and what isn't. The baseline tariff, 10%. Can we dial that up and down? The tariffs on autos, can we move that? The tariffs on steel and aluminum, are they negotiable too? Important signals for other people set to follow to go into the White House and make these kind of deals.
Yeah, and unclear whether we're going to get those signals completely, because this will be more the contours of a deal and it takes much longer. But you're right. How significant is it that this is coming ahead of the talks about talks this weekend with China at a time when that ultimately is a real question mark for a lot of people, how that trade tension gets resolved?
It's difficult to make central bank policy decisions in this mix, isn't it?
Wait and see.
Can change like day to day. Wait for 30 minutes and you might get a trade deal. Wait a few hours and you'll hear what the US and UK has in store for you. Wait for a Bank of England rate decision. We'll get to that in just a second. Coming up this hour, we'll catch up with Gargi Chaudhuri of BlackRock as President Trump teases a major trade deal. We'll speak to Nouriel Roubini of NYU Stern, saying no pain, no gain for the US economy. And we'll catch up with the former Kansas City Fed President Esther George on the Fed's wait-and-see approach. I promised you an update on the Bank of England. We begin this out with another central bank decision, this time from the BOE. Joining us from London, Bloomberg's Lizzie Burden. Morning, Lizzie. What's the latest?
Good morning. Well, the Bank of England has just released its rate decision, cutting rates to 4.25%. As we expected, John, that was fully priced, unanimously expected by economists, because, as you say, they needed to take account of Donald Trump's trade war. What is interesting here is it's a three-way split because of the hit of tariffs to growth, and that has impacted the vote decision here. You had two wanting a bigger half-point cut, and another two voting to hold rates. So an absolutely split committee here. I remember the days of Tom Keane telling me that, is there groupthink on the MPC? Certainly not today, because of the dispute about how Trump's tariffs are going to affect the UK economy. Looking to the guidance, this is interesting. We were wondering whether they were going to drop the language about the rate path ahead being gradual and careful, but indeed they've stuck to it. Bailey saying that they need to keep that approach. If they had dropped gradual, maybe it would have been a signal that there could be a June cut on the table, and that would have been the first back-to-back cut since COVID, and before that the financial crisis. That is not a signal that the governor is trying to send today. They're also looking at inflation at 1.9% in the second quarter of 2027, 1.9% in the second quarter of 2028. So they've updated these forecasts, 1% growth in 2025, 1.25% in 2026. But they've said that the growth risks are to the downside. For CPI, the risks are two-sided. So this is kind of echoing the ECB there in the sense of how the tariff war is going to affect the UK economy.
You know, Lizzie, it's just amazing to see the dissenting members and just how split they were. The two ones who wanted to see a bigger rate cut, saying that they saw a risk of sustained fall below the inflation target, and the ones who wanted to just keep things on hold, including Catherine Mann, saw inflation persistence in resilient jobs market and inflation expectations ticking up. I'm just curious how surprising it is to you to see this type of breakdown with diametrically opposed takes on just what the ramifications of these tariffs would be.
Well, look, Catherine Mann is always one to surprise us. She is an activist, remember, on the Monetary Policy Committee. But remember, she surprised us by voting for a jumbo cut back at the February meeting and then for a hold in March. So maybe less of a surprise that she's going for it at this meeting. But yeah, a real surprise to economists that you would get a three-way split here. We knew that Swati Dinger was the archdove on the committee. Repeatedly, she has emphasised the risks to growth. But we'd heard from Megan Green on Bloomberg TV talking about how the tariff impact would be disinflationary. It was surprising to hear that from a hawk. So we already knew that there was this disagreement on the MPC.
Lizzie Burden with the latest from London. Lizzie, thank you. The latest from London. Governor Bailey is trying to convey confidence and stability, the need to stick to a gradual and careful approach. The vote mix is just chaotic. 5 voting for a quarter-point cut, 2 for a half, 2 for no change.
On one level,
clear as mud.
You have to give a sense to Fed Chair Jay Powell that he reflects that with wait and see, wait and see, wait and see, wait, because ultimately it gives you the sense of just how chaotic and split things are when you have a real-time measure of just how differently some pretty serious economists really think of things.
Let's turn to the Federal Reserve. Gargi Chaudhuri of BlackRock writes in the following: we do not expect the Fed to cut rates in June. July will hinge entirely on how the current disparity between the hard and soft data starts to resolve. Gargi joins us now for more. Gargi, good morning.
Hi, good morning.
Stuart Kaiser of Citi was in your seat about an hour ago, and he said this soft data can change really quickly. How quickly can it change if the president comes out this morning, 3 hours away, and says, deal with the UK, and others will follow?
Right, so the price action this morning on the deal with the UK, obviously exciting to see. Markets are treating this as a good piece of news. But I don't necessarily know how much that will change in terms of dynamics around consumer confidence or CEO confidence. This is a country with which we've already had a trade surplus. So to the extent that this is just a signal in terms of the art of the deal, but I don't know how much this will drive inflation or growth expectations. So really, Jonathan, to your question then, as we think about the hard data, soft data dichotomy, what it'll really be about is to what extent the labor market remains as strong as it has been. And I think that's a point that Chair Powell was trying to not make yesterday. And I think he did a pretty good job of waiting and seeing 22 times. And I think that is what we're looking for when we talk about the hard data and soft data coming together. Does the labor market begin to show some signs of faltering, or do we stay right here and the inflation data actually ticks up, but the market believes it to be just temporary?
We've got to define what a deal is and what an agreement is. We're hearing from a UK official that the UK-US deal will set out general terms of an agreement. Will it lack substance? Will it lack detail?
My guess is probably, considering the fact that the detail is where the devil lives. So are we going to answer the questions that you put out there? Are we going to have certain sector-specific tariffs lifted? Are we going to have any address of steel? Or is this going to be some sort of discussion of, we love each other, it's going to be great, make America and England great again?
Maybe that's enough for the equity market, I don't know. But to your point about the hard data, let's say the hard data starts to break the wrong way. Let's say claims continue to inch higher. Maybe they gap higher. I don't know. But let's just run with that for a moment. Will this market put weight on that, or will it put weight on trade talks and the prospect of that data getting better again?
So I think it'll depend on the trade talk. So, for example, today, I think what I'll be looking for is exactly what you were saying, Lisa. To what extent is it just headlines? And that's great. But to what extent is it actually details? We also heard this week that UK and India reached a trade deal, which again is good news, but it took 3 years. So some of these trade deals you don't get some of the details. And again, coming back to your question, Jonathan, I think that if the hard data starts to soften meaningfully, I think where it softens is really important. So if it's labor market and we're actually seeing a meaningful slowdown, I think that will impact the equity market. And actually, we saw a hint of that earlier last week when we saw that backward-looking first quarter GDP. When that number came out, again, it was expected to be weak, and of course, it was distorted by import data. But when it came out to be weak, the equity market did respond to that. So the first hard data weakening that we saw a whiff of, the markets did respond to that. And of course, then we had a slew of other good things that it also responded to. We're telling investors, based on all of these things, we're telling our clients, definitely stay invested in the markets, because obviously we've seen what a rebound can look like, but play a little bit more defensive here with minimum volatility strategies.
Yeah, you pointed out that you have an index that tracks soft and hard data, and what it indicates is it's going just as bonkers and volatile as the rest of us as we try to understand exactly what the details of anything really are. What does it mean to be diversified in this type of environment where it's unclear about the relationship between bonds and stocks?
Exactly. So I do want to point out that in April, and I think Kelsey, who was here earlier, was talking about this, bonds have done well after that initial wobble in the very long end in the early April. The ag, as well as the global ag, did give you some diversification, not the very long end perhaps, but if you were in the very front end or the belly of the curve, you did do well last month. And I think that's important. But what clients have more and more been asking of us is, given the volatility in the long end that you did not expect to see, given the volatility in the dollar that also you didn't expect to see last month, what are the other sources of diversification? And we think that, focusing on the front end and the belly of the fixed income markets is really important, but add other things. And here, this is where we think inflation-linked bonds, gold, liquid alternative strategies like global equity market neutral strategies, which again, don't take a lot of beta risk. We think having those as a part of your portfolio is really important.
How much does it sort of undermine this huge shift to broad indexes tracking the major indices, given the fact that a lot of this has to do with something very different?
Look, we've always been telling investors that even though the last 10 years, for example, if you just owned 7 stocks, you did pretty well. We've always told investors to have a diversified portfolio. I don't think the discussion is about whether you hold it in an index product or whether you hold it actively managed. Obviously, this is a time where active management and being nimble around rotating your factors can matter a lot. So I don't think it's about that, but I think it's about recognizing the risks in your portfolio and recognizing maybe just having only 7 large cap stocks versus having a little bit of international exposure, having some diversification in terms of front-end fixed income, or even having a little bit of gold can make a difference.
Gargi Chaudhuri of BlackRock is going to be sticking with us. More headlines for you, this time from Russia and China. Putin and Xi signing a statement on further cooperation. The positioning here going into the weekend talks is really quite interesting. The US is about to hold a news conference in the Oval Office in 3 hours' time to talk about an agreement with the UK. Look at us, a trade agreement. The Chinese are playing nice with the Russians, saying, look at us, just signed a statement on further cooperation just ahead of talks in Switzerland between the two nations.
So this is what Xi Jinping has done. China has signed a pact with Vladimir Putin about having some sort of global stability and further cooperation. They have cut rates and actually tried to fortify their economy. And they have said that they will only negotiate if you drop tariffs down. President Trump has said we will not drop tariffs down ahead of negotiations. We have a trade deal with the UK that we're going to announce. And suddenly, the idea of big tech is on the table as a negotiating tool. These are the ways that they are trying to line things up heading into this weekend.
It's interesting framing, isn't it? Closing out the trading week, another day of it. Equity futures at session highs on the S&P 500. We're higher here by 1 full percentage point. With an update on stories elsewhere this morning, with your Bloomberg brief, is Yahara. Hey, Yahara.
Hi, John. Pakistan says it reserves the right to retaliate after India launched targeted strikes. Meanwhile, India said it conducted a precise and restrained response that was designed to be non-escalatory in nature. Pakistan's army said 31 civilians were killed in the strikes and called the move an act of war. Meanwhile, more than 70 people were arrested after masked protesters occupied Columbia University's library yesterday. Law enforcement officials say protesters took over part of the building and draped Palestinian flags on the walls. Secretary of State Marco Rubio said on X protesters' visa status are under review and pro-Hamas thugs aren't welcome in our great nation. And Danish shipping giant Maersk cut its forecast for the global transport market due to macroeconomic and geopolitical uncertainty. Maersk, which controls about 14% of the world's container fleet, sees 2 scenarios for the rest of the year: a growing risk of demand contraction, or of course the possibility that trade rebounds if tariffs are rolled back. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate the update. More from Yahara later this hour. Up next on the programme, getting to the negotiating table.
China says in order to have substantive negotiations, you have to bring down your 145% tariffs. Are you open to pulling back your tariffs in order to get China to the negotiating table?
No.
A very simple no. We'll get into that no in just a moment with Annmarie down in Washington, D.C. Live from New York City this morning. Good morning. Equity futures doing nicely here on the S&P 500, higher by 1 percentage point after snapping a two-day losing streak in yesterday's session, inching higher and adding some weight to the rally this morning. On the Nasdaq 100, higher by 1.3%. Under surveillance this morning, getting to the negotiating table.
China said the U.S. initiated the trade talks this weekend and that its position hasn't changed. Are you still confident you can reach a deal with China?
They said we initiated? Well, I think they ought to go back and study their files.
China says in order to have substantive negotiations, you have to bring down your 145% tariffs. Are you open to pulling back your tariffs in order to get China to the negotiating table?
No.
So here's the latest this morning. Beijing reiterating its call for the U.S. to cancel unilateral tariffs ahead of this weekend's trade talks. The president showing very little interest in doing just that. Annmarie joins us now from Washington for more. AMH, let's get into this one. How things are framed going into these negotiations this weekend.
Well, Jonathan, I think you framed it very well yesterday. There are talks about talks. This is really just the first contact point to discuss trade between the world's two biggest economies when you have these tariff rates that the president, the Treasury Secretary, China has called unsustainable. 145% on China, 125% on the United States. So clearly what you're seeing and sort of reading the tea leaves is that potentially one deliverable leading these meetings, if the talks go well, is that there would be a drop when it comes to the tariff rates. The president was asked about this yesterday. This is something that China said they wanted to see drop before they even decided to sit down at the table. And he said no. But I would go back to what the Treasury Secretary said over the past few days when he was talking to Fox News about the fact that him and the president know what they want to get out of this relationship and the parameters and the red lines. The issue is they want to keep this uncertainty, this game theory of strategic uncertainty. So potentially we could see the rates drop, but the president's not going to say that out in the open before he sends his USTR ambassador and his Treasury Secretary to sit down with Beijing.
Which raises a question, Annmarie, about what we can expect at 10 a.m. Eastern time when we get the announcement between the UK and the US. How much certainty is going to be embedded in that if uncertainty is sort of necessary for this administration heading into talks this weekend?
Well, I think this is an entirely different relationship. This is a special relationship. You've seen the Prime Minister, Keir Starmer, also really work the phones. He came here for a visit, gave this unprecedented invitation for a second state visit from King Charles to President Trump. There has been a lot of discussions. We shouldn't even just say the past few months. Years. Since 2016, the United Kingdom has wanted to get some sort of deal with the United States over the finish line. So I would look at these two different economies very differently when it comes to potentially the trade outlines we are going to see. China is going to be very difficult and is going to take a very long time. The United Kingdom, this framework they come out with today, then they're going to work out the details the next few months. But this framework, this blueprint will likely stick. And the two main issues you need to look out for at 10 a.m. is the 25% rate on aluminum, steel, and cars of UK imports coming to the United States. The Prime Minister out of the UK, Keir Starmer, wants to see that cut. That is critical to the UK industry. And for the United States, they want to see the ability for U.S. auto manufacturers to have easier access in the United Kingdom. And, of course, the digital services tax, something this administration wants to see the United Kingdom and, frankly, other countries lower.
Trade deals are hard. They're complex. They take time. And sometimes they're reduced to one good, one product, one thing. And the issue with the US and UK often comes down to chlorinated chickens. Annmarie, it sounds ridiculous, but these are the things that are hard to come to agreement on. Do you think agriculture, food products are going to be part of this template, this framework for a deal?
Well, I'm not sure if they're going to be part of the template and the blueprint for this deal, but potentially they will talk about this is something they are going to investigate and maybe try to get a little bit more of a fair footing. We should note there have been reports for the past few weeks that this was a red line for the United Kingdom. They do not want UK chlorinated chicken, beef that has hormones in it, coming from the United States into the UK. It'll make it very challenging for the United Kingdom to then get an agreement with the European Union, which blocks these products outright. But this is something that is really important to the president. If you look at the figures from the agricultural department, you have seen, mostly because of China, there has really been a steep drop in U.S. exports of soybeans, of pork. You had Rep. Bacon over the weekend from Nebraska talking about the fact that the Midwest is on the cusp of potential recession, and they're hoping to get some relief from this administration. Remember, Trump 1.0, there was a bailout for the farmers, and potentially we could see that this time around as well.
Annmarie, appreciate the update. AMH down in Washington, D.C. More from Annmarie on that story in about an hour from now. It often comes down to silly things, Lisa, and sometimes it is things just like chicken. You just can't come to an agreement on something like that.
This might all come down to how the U.S. and UK treat their chickens differently, because ultimately the chlorinated wash is to remove bacteria. It is supposedly safe, but the UK and other places say it masks unsafe and unsanitary practices, like having chickens too close together, which might be the reason why the U.S. and the UK might remain far apart.
This has come up a million times as we've attempted to have these trade agreements in the past. We'll see what happens here. Gargi Chaudhuri of BlackRock still with us. We're not going to talk about chickens, don't worry. Are there certain nations, certain geographies that you think could become a haven for trade and a better relationship with the US that might present an opportunity to invest in at the moment?
Yeah, so we talk about this in our spring outlook that we just published towards the end of April. And the one area that we talk about is actually, number one, just recognizing that most advisors don't have much international allocation. And especially in a world where perhaps the dollar remains a little bit more range bound, having that allocation is exceedingly important. And then focusing on some regions that we think might even benefit in the medium term from some of these trade reroutings and the geopolitical fragmentation. And we think Latin America certainly is one of those regions that, especially when we think about Mexico as being one of the regions that haven't had as much of a tariff increase as given some of the negotiations that have already taken place, Mexico and Brazil could, we think, potentially benefit. So Latin America, again, one region that we think in the medium term could benefit. And broadly, I think international is an area of the market where most advisors, we look at portfolios, have not had an allocation to, or they've had a massive underweight to, and where they've had an overweight is to small caps. So what we're telling investors is perhaps rethink your small cap overweight and rediversify into the international markets, focusing on regions that you might not have had access to in the past.
Does that include China?
I think for now, as we're still going through negotiations, we're going to learn a lot about China. I certainly think you cannot have an international portfolio without China. We're telling investors, go into EM. We're telling investors, EM with a minimum volatility tilt, which does have China within there. So again, have that in your portfolio, but do that in a minimum volatility fashion.
What is that? Can you describe that? What is a minimum volatility strategy?
So absolutely. Thank you for asking that question. So both in the US as well as in EM, what we're suggesting is minimum volatility. And what does that mean? What that means is you have the participation in the market. So you're still invested. If the market goes up, you are experiencing those up days. But on the down days, you are just getting a little bit of protection. So your downside is better protected because your beta to the rise in the equity markets is lower than 1. So being a little bit more defensive and winning perhaps by losing less. And what we find is often in these periods of volatility, like we've seen over the last 2 months, a lot of investors flock to cash. And then, of course, you have the issue where you lose out on these immense turnaround days. So by having a more smoothened path with some of these strategies, we think makes a lot of sense.
Have you got an ETF for that?
We do have an ETF.
Of course you do. I knew you had an ETF for that.
It's called USMB.
There we go. Gargi Chaudhuri of BlackRock. That was the pitch. Gargi, good to see you. As always, thank you. Up next on the programme, Nouriel Roubini of NYU Stern saying no pain, no gain for the US economy. That conversation up next. The The S&P 500 near session highs, up by 1 full percentage point. On the Nasdaq, we had some more weight to the rally, up by 1.3%. The why from the President of the United States later this morning, 10 a.m. Eastern Time, an agreement with the UK, a full and comprehensive one that will cement the relationship between the US and the UK for many years to come. Many other deals which are in serious stages of negotiation to follow. That is your top story this morning. With some morning movers, let's get a few of them. 2 hours away from the opening bell. It's Danny Berger for more. Hey, Danny.
Hey, John. We had some earnings to get through this morning, starting with Warner Bros. Discovery, down about 1 1/3%. They missed on their revenue. Just under $9 billion where the figure came in. The expectation was it would be above $9.6 billion. Now, for its part, Warner Brothers blamed the difficult comps that around the first quarter of last year, you had movies like Dune 2 and Kong versus Godzilla, which I haven't seen, but I'm sure it's lovely, but saying that those tough comparables meant that things looked a little bit worse this time around. We also heard from Coors, Molson Coors, another disappointing outlook. They cut their guidance to the single-digit growth for both sales and earnings. Those shares falling some 6%, blaming, like we've heard from so many other companies, a weaker macro environment, weaker consumer demand, also announcing that their CEO would be stepping down at the end of the year. Wrapping things up with a bright spot in the earnings we've gotten before the bell this morning. Carlyle shares are higher by 1.5%, surprising to the upside with their earnings. Confidence, perhaps, that finally Carlyle is returning to growth for this private capital giant. But in a sign of the times, things other than private equity have been picking up in terms of profit share, so things like their credit arm as well as their capital markets, as the deal-making environment remains very challenging, John.
Hey, Danny, thank you. Appreciate the update. More from Danny in about an hour from now. On our radar this morning, President Trump preparing to make his first trade announcement this morning. The president posting on Truth Social, the agreement with the United Kingdom is a full and comprehensive one. More details expected at a White House press conference at 10 a.m. Eastern Time.
And it will be interesting to see what the contours of this deal are, particularly, as you've been saying, John, how it deals with cars and steel and some of the other levies that have been imposed on top of that 10% bench line across the board tariff. A key question here, does this all come down to cars? You keep talking about this, and I was looking at the movies because a lot of movies are made in the UK, so it's sort of another sort of sectorial tariff. But I'm just curious, is it really just about cars and the fact that the USs are not being sold in Europe?
I think Jaguar Land Rover would like it to be all about cars later on this morning. They've got huge exposure to this story. I wonder how bespoke this deal actually is. Whether it is unique to the UK, whether it's a template for other countries. We talked repeatedly already this morning about the special nature of the relationship with the UK. Not just the history, but also the trade balance is balanced, unlike many other nations. And agriculture's in the mix too. I've got to promote our interview a little bit later this morning. In about 60 minutes' time, we're sitting down with the 33rd US Secretary of Agriculture, Annmarie, catching up with Secretary Brooke Rollins. And this has got to be a feature. She's heading to the UK on Monday.
Yeah, and right now, as some of the trade is halted, as people try to figure out what the contours, what the rules of the game really are, there is the concern of some sort of recession in the Midwestern states that are heavily tied to agriculture. Does this all come down to chicken and eggs, which we can discuss at length about how different they look in the UK versus in the United States?
Chicken, eggs and chips. Different kind of chips. The White House planning to reverse some Biden-era AI chip curbs to appease major tech companies. It's been a long week. And some foreign governments. Trump won't enforce the so-called AI diffusion rule when it takes effect on May 15th.
I find this fascinating. There is a question about whether this is softening some of the restrictions ahead of the Chinese negotiations, or whether it's just simply taking another tool, another lever in the negotiation that is to come, maybe in the talks about what kind of restrictions there are with chips. This, though, is not necessarily about chips being sold to China. This is about chips being sold to other allies that could potentially make their way to China. So it really is more about maybe the Middle East trip next week than it is about the Chinese talks.
Precisely. The president is going where? The president's going to the Middle East. And the Middle East is hoping this is directed at them.
And then they can buy more chips, and this has really restricted their ability to necessarily expand into the AI stream. I also wonder how much this is underpinning some of the rally that we're seeing this morning in the market, because we saw NVIDIA rally 3% yesterday, and they've been arguing for some sort of ratcheting back of this diffusion.
Without a doubt, into the close yesterday.
Yeah.
Forget Chairman Powell.
Exactly.
It's this story right here. NVIDIA up again by 1.6% in the pre-market. So that's trade. Let's talk about taxes and the deficit, debt, the kind of thing that Lisa likes to talk about. The Treasury Secretary, Scott Bessent, in the hot seat on Capitol Hill.
What about the long-term debt? Will it go up or down if this big, beautiful bill passes?
Again, sir, While the absolute...
I think the reason you're having a hard time answering...
I'm not having a hard time answering because what is important
I've given you plenty of
isn't
time.
the absolute level of debt. It is, as Secretary Yellen said, the debt to GDP.
Everyone is talking about the $37 billion. Is it going to go up or down?
Sir?
Yes. Is it going to go up or down?
It will likely go up, but if the GDP goes up faster, we don't care.
Secretary Besant articulating the argument, I think, quite well there. I'm not sure what the lawmaker didn't understand. It's not about the overall level of the debt. It's about the debt relative to GDP.
Oh, come on. You know what he was trying to do.
I know
He was trying to
exactly
get
what
a
the
sense.
official in Washington was trying to achieve, but ultimately it's just ridiculous and doesn't serve the public well at all.
There is this question of just how they message this going forward when they have to focus on the growth aspect of things. I'm trying to be diplomatic here. I agree with you in talking about the taxes side of things and the deregulation side of things to offset some of the increases in the deficit.
If you take on $10K of debt and I give you a $100,000 pay increase, you know, it's debt relative to income. What matters more? The fact you took on 10K of debt?
Totally. I actually would have been much more interested if that lawmaker had said, how are you going to finance this? Is it going to be in 30-year notes? Is it going to be in 10-year notes? Or is it going to be in 2-year notes? Because that actually will make a big difference. And you got into the negotiation of just how the auctions could go. There is a 30-year auction today. I would have been very interested in that discussion.
Keep dreaming, Bramo.
Thanks.
Let's turn to the economic policy. Fed Chair Jay Powell emphasising the central bank is in wait-and-see mode. Pending trade negotiations, Nouriel Roubini of NYU Stern is saying no pain, no gain. American democracy will survive the shock. And after an initial period of pain, the US economy will thrive. Nouriel joins us now for more. Nouriel, good to see you. You're often painted as doom and gloom, the big bear, but I've spent many a time with you and we've had conversations where you're constructive and it feels like this is that moment. What are the factors that lead to that constructive view for you?
Well, I've recently said that tech trumps tariffs, and what I mean is that US is really number one in many of the technologies of the future. AI, machine learning, robotic, automation, semi, fusion, quantum, defense tech, green tech, ag tech, fintech, you name it. And I expect that actually US potential growth because of that could increase from the current 2% towards 4% by the end of the decade. So that's a 200 basis points increase in potential growth. Even tariffs, and there'll be some de-escalation, restriction, migration, best estimates that they could reduce potential growth by 50 basis points. You have 200 on the plus, 50 on the minus. So there's a ratio between 4 to 1. So I think that that's why that over the medium term, the fact that the US is very innovative implies that whatever Trump does doesn't matter. So tech trumps tariff, tech trumps Trump too. And the traders, of course, Trump, and they forced him to back down through market discipline. The most powerful people in the world are the bond vigilantes. So I think he's boxed in. There'll be de-escalation. We'll still have an inflation rate. You know, I expect that the trade deal will imply that for most of the world, you have tariffs between 10 to 15%, on China 60. But even with 10 and 60, that is what actually Trump was announcing in the campaign trail, you get inflation, core PCE, towards 4% by the end of the year. That's aid to disposable income. You have weakening of consumer and business sentiment. You get a short and shallow recession by Q4. It's going to be short and shallow because then the Fed is going to cut rates since inflation expectations are the anchor. But we'll have a short and shallow recession by year end. That's probably highly likely.
Can I jump on that point? What gives you the confidence the Fed can respond to that? Because there are some people who are worried about the inflation that might pick up and the fact that might constrain the Fed's dovish bias.
No, you're right. That's why people are already saying they should have cut in May or in June or July. I don't think it's going to happen before September because, as Powell said yesterday, inflation will be higher, unemployment is going to be higher. Last time around, they made a mistake. They thought that the increase in inflation was temporary and was not, and then they had to catch up on it and so on. So this time around, you can make the arguments that since inflation expectations are anchored, since the Fed is not wimping out and being forced by the White House to cut rates right now, when inflation rises, it's going to be a level effect rather than a rate of inflation. If inflation expectation remains anchored, if you don't have second round effects, then once unemployment rate goes higher, that weakens the labor market, then the Fed is going to feel comfortable to cut rates. But right now they have to stay on hold exactly because they need to cut once then the economy weakens significantly.
People have been talking about stagflationary-like scenarios. That growth is slowing, and as you acknowledge, that would probably happen to some degree in the near term, and that inflation was going to remain higher as some of the trade arrangements get readjusted. Why is that not a significant concern for you at a time where even the Fed seems to not have clarity on whether that's going to be the predominant theme?
It's stagflationary. Growth is going to be lower. In the recession, inflation is going to be higher. I think the difference between now and, say, the 1970s, when you had the oil shock of 73 or 79, was the inflation was already high and rising, and the Fed was behind the curve, and then you had the anchoring of inflation expectation. This time around, I think they've shown some credibility in anchoring inflation expectation. You're right, however, that you never know. Second-round effects may occur. You have not only the impact of the tariff, now the dollar is weakening, that's another impact on import prices. That's why the Fed has to wait until the hard data show that there is the beginning of a recession. If they start cutting rate earlier, then you have the anchoring of inflation expectation, and that's going to be a problem.
How much are the Fed's hands tied? Because the long end of the yield curve is not necessarily anchored to Fed policy in the same way, especially given some of the deficit concerns. And I know that Congress member wanted to talk about what was going to happen with the total pool of debt, not the debt to GDP, but I'm actually curious about how they issue that debt and just what that does to some of the yield premium going forward.
Well, the long end depends on the Fed in terms of inflation expectation, and depends, as you point out, risk premia or term premia on fiscal policy. I think the administration is sensitive to the idea that if you have a very large deficit, eventually bond yields can go higher, they can further crowd out the economic recovery. And we'll see the results of this fiscal plan. Some of the stuff they're doing are going to increase the deficit. Some of it, like tariffs or reduction in IRA subsidies, Medicaid, DOGE cuts, will reduce the deficit. I think they'll be quite sensitive not to have a headline number for deficit next year. It's higher this year because then bond yields will go much higher, and that's going to hurt further the economy. But because you're going to have a fiscal drag, I think, most likely next year, then the Fed has room for easing a little bit more. Now, they want to start also manipulating the long end of the bond yield curve. I wrote this paper with Steve Miran criticizing what Yellen was doing by reducing the supply of long debt and issuing more of the short one. But this time around, it's not just the ratio between the two. They're talking about buybacks, literally buying more of the long term to get it out of the market to issue more of the short term. That is doubling down on this ATI policy, just doing more of it, actually, rather than less of it.
Nouriel, there's only one person I know with more air miles than you, and it's our friend Mohammed Al-Arian. You travel the world a ton.
Yeah.
Have attitudes towards US assets changed? Have the conversations shifted in the past few months?
They've shifted, but I would say there's going to be a difference between fixed income investors. Many of them can be sovereign, either central banks or sovereign wealth funds. These folks are worried about the deficit, are worried about us having damaged the credibility of the United States. That's why you had higher bond yields and a weakening dollar. So that trend may be continuing because they're going to have to get out. And the rivals of the US, like China, they have to get out of dollar assets. Probably they're going to go into the gold and things of that sort. But my view is that since there will be an investment boom driven by this increasing productivity, CapEx in the US is going to be much higher. The current account deficit is going to become larger, even with the tariffs, just because investment is going to be higher as a share of GDP. Savings are going to remain low because private and public savings will be low. So our current account deficit is going to be wider, but the inflow of this financing is going to be both FDI and portfolio investment into equity market. So you have actually more even overweight in U.S. equity assets over time because of the increasing secular
Can we just
boom.
sit on that? This is really important.
Yeah.
So we've been debating now for a number of months about whether this was a cycle-level shock or a system-level shock.
Yeah.
The policy announcement of the last month. And we wondered whether that structural long into the US dollar, which is a system-level story, would be disrupted. Are you saying that will stay the same, that you'll just see this flood of money keep coming in to the United States, into US assets?
As I said, in fixed income, maybe people are going to try to get out, especially if the deficits are larger, unless bond yields are much higher. But I see an investment boom in the United States, an increasing productivity, secular boom, and therefore being overweight in U.S. equity is going to become the story over the next few years, and that's going to compensate any exit out of fixed income assets. So the dollar is going to weaken, but it's going to weaken gradually, and the reserve currency role of the dollar is going to be dented but not damaged to any significant extent. So we can live in a world in which actually the U.S. current account deficit is going to be much larger, but driven more by booming investment rather than weak public savings. The dollar remains strong, and we're going to live with that because there'll be strong economic growth.
You mentioned some of the diversifying that you could see away from the dollar to things like gold. Any other thoughts on where that money might go beyond just gold?
Well, if you're a rival of the U.S., say China, if you dump your treasury, first you have a mark-to-market loss on the value of those things. If you sell treasury and buy RMB, you appreciate the RMB, something you don't want to do. If you sell dollar instead of buying RMB, you buy yen and euro, you appreciate the yen and euro, and you upset the Japanese, the Europeans. You want to have good relations. So what do you do? The best thing you can do is to sell treasuries and buy gold. And that's why gold has been going higher. Because gold is the only reserve asset that cannot be seized. Because we've seen in the Russia-Ukraine that even yen, euro, Swiss franc, pounds can be seized. So I would see gold being the biggest winner. Now, over time, of course, the Chinese want to have a new rail of payment systems that is bypassing the US dollar and SWIFT. And there are now technology that gradually, over time, are going to allow them to do so. But I think it's going to be a very gradual process. So the dollar is going to remain meaningful global reserve currency.
Nouriel, super thoughtful as always. It's good to see you, sir. Thanks for dropping by. Nouriel Roubini there of NYU Stern. If you are just joining us, equities at the moment up by 0.9% with an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara. Hey, Yahara.
Hi, John. Boeing is promising to deliver a new version of Air Force One by 2027. The project has been delayed due to workforce limitations, supplier problems, and design issues. President Trump has demanded a new plane before the end of his second term and expressed frustration with the delays, even considering alternative options. Meanwhile, Apple is considering revamping the Safari web browser to focus on AI-powered search engines, potentially ending its longtime partnership with Google. Apple has already had discussions with Perplexity AI and is looking at other AI providers, including OpenAI, DeepSeek, and Grok from Elon Musk's xAI. And Nintendo forecasts weaker than expected initial sales of its Switch 2 due to uncertainty around U.S. tariffs. The announcement comes despite market expectations that it would be the fastest-selling console in history. Nintendo lifted prices on some accessories and warned price hikes on other products might be coming as well. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next on the program, the Fed's pain threshold.
What the Fed has to do is probability and scenario analysis. That's all we can do. Our recession scenario is 60% probability.
Up next, the former Kansas City Fed President, Esther George. Equity futures near session highs were up by 0.9%, just fading a touch on the Nasdaq 100, positive by 1.2 percentage points. That's the equity market story. Under surveillance this morning, the Fed's pain threshold.
What the Fed has to do is probability and scenario analysis. That's all we can do. Our recession scenario is 60% probability. It gets down to how much pain are you willing to endure before you feel you need to cut? What is the pain threshold and the trade-off for the Fed? And how late are they willing to be?
Here's the latest this morning. The Fed Chair Jay Powell emphasizing a wait-and-see approach as a growing chorus on Wall Street lifts recession odds, citing tariff-related stagflation concerns. Joining us now to discuss is the former Kansas City Fed President, Esther George. Esther, welcome back to the program. It is the central banker's dilemma, the prospect of higher inflation, higher unemployment, and decelerating economic growth. It's a challenge. What did you make of the chairman's ability to rise to that challenge in yesterday's news conference?
Well, I thought based on what I heard in the market reaction, he stuck to the story that he's been telling, which is we're holding these rates until we can get more clarity about the policy mix. And I also heard in his comments something interesting. He certainly highlighted tariffs. That's been the topic of the day. But he also mentioned we have to think about the impact of immigration policy changes, fiscal policy changes, and this emerging prospect of how regulation might change around this. So that is a pretty big dynamic to try to play out when you're judging the appropriate stance of monetary policy.
Esther, do you have a better sense of what the reaction function is when it comes to looking at different indicators, whether it's soft data or hard data, and understanding how the Fed would prioritize certain readings, how they would respond to, say, an increase in unemployment, if also it came in tandem with increasing inflation?
Yeah, so I think, Lisa, the soft data is really important right now. And you do see the Fed looking at that. You see that come through in the Reserve Bank's Beige Book data. You know they are out there really just combing the landscape to hear from different parts of the economy what they expect. And I think what they're hearing right now is we're not sure. We are pausing, we're waiting. The Fed knows that even pausing has a negative impact on the economy. But I think for the U.S., we've come into this at a time of strength in that economy and judging how much will come off of growth, how much will hit the employment numbers, and certainly watching inflation expectations at a time like this are a dynamic that just takes time, I think, to figure out.
Yesterday on Bloomberg TV, Bob Michael of JPMorgan Asset Management noted that the word transitory was used as recently as the March 19th meeting, the last time the Federal Reserve met. Do you think that it was a mistake for them to say that? It was notably absent from yesterday in reference to any kind of inflationary impact from the tariffs that have been put on.
Well, I think it probably was intentional to drop that word. It has taken on some very negative connotations, maybe rightly so. But the truth is, we know that these kinds of shocks can be a one-time price level shock. I think what we can't know right now is the fact that we already have elevated inflation relative to the Fed's target. We know that certain measures of inflation expectations are moving in ways that flash caution. And so I think you can't know how this dynamic unfolds with inflation without a little more sense of when these policies get better able to be quantified and put into the models that the Fed's looking at to know. Not if. I think this is a Fed that is clear. We are on a cutting path. We've taken a pause. It's really a question of when.
How do you know, Esther, the difference between the two? Because clearly the committee struggled with what was transitory and what wasn't coming out of the pandemic. So how would they know the difference this time around? The difference between inflation being short-lived and more persistent? Do you just have to wait a long, long time? How do you know the difference?
Well, you absolutely cannot know the difference. And that is really the crux of uncertainty for a policymaker, is to read into this whether you will continue a disinflationary path, that underlying sense of inflation where we were, and really watching inflation expectations. So for me, I think keeping an eye on those inflation expectations will tell the committee a lot about what they're dealing with relative to a one-time versus a more permanent impact to inflation.
And Esther, just to double down on that, do you put more weight on survey-based expectations or market-based expectations?
Well, I think you have to look at both. And normally you might say that some of these household survey measures and other things are not so definitive around where inflation is going. I think what's gotten my attention this time is how dramatically they are moving. And so that in and of itself tells you that the volatility you're dealing with has to give you some pause. And I think it's right for the Fed to pay attention here to how these dynamics are unfolding.
And that's certainly what they're doing. Esther, appreciate your take as always. The former Kansas City Fed President, Esther George, on the challenge this Federal Reserve faces.
Yeah, basically saying you can't totally throw out the University of Michigan inflation survey. You can say maybe it's not the correct magnitude, but it's moving pretty quickly, so take notice.
Take notice and wait and see. Up next on the program, Darrell Cronk of Wells Fargo, the U.S. Agriculture Secretary, Brooke Rowlands, Nela Richardson of ADP, and Mike Collins of PGIM. From New York, this is Bloomberg.
Today, the Federal Open Market Committee decided to leave our policy interest rate unchanged. The risks of higher unemployment and higher inflation appear to have risen.
The Fed is not really sure where tariffs are going to land, and when they land, they're not really sure what the consequences are going to be.
Uncertainty has clearly risen. The pain threshold for the Fed is going to be elevated.
We're getting slowing growth in the second half of the year. The question is, what will they do about it?
We're under known unknowns and unknown unknowns. The probability on both bad outcomes has gone up.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. The third hour of Bloomberg Surveillance starts right now, 90 minutes away from the opening hour, with equities up nicely for a second session, up by 0.9% on the S&P, on the Nasdaq up by 1.2%, as the President of the United States teases the unveiling of an agreement, a framework for a deal perhaps between the UK and the US. More deals to follow potentially after 10 a.m. Eastern Time.
And that's the reason why people are all watching this very closely to understand just what's on the table. Key question is how much are the sectoral tariffs, whether it's movies or whether it's cars, as well as chickens, that potentially could set the rules of the road, not just for when it comes to trade, but also when it comes to these negotiations.
Setting the tone going into the weekend. A sit-down in Switzerland between the United States and China. Going into that, equities elevated up by 0.9%. Coming up this hour, we'll catch up with Darrell Cronk of Wells Fargo as trade talks fuel investor optimism. Gil Luria of D.A. Davidson on Trump's move to bring down AI chip curbs. And the U.S. Agriculture Secretary Brooke Rowland ahead of, quote, a major trade announcement. Got some breaking news just moments ago for the EU, potentially, on tariffs. Joining us now for more is Annmarie. Hey, Annmarie.
Hey, Jonathan, tale of really two trade deals this morning. The president and the United Kingdom looking to ink an agreement for a trade negotiation, while the European Union, Brussels, is looking at potentially how they might fight back when these talks kickstart in earnest. Remember, the talks have been very scant between Brussels and Washington. They are going to start to take place, and the European Union is coming out with a list on what they could go after if the talks go south. Things like industrial goods, like Boeing jets, U.S.-made cars, bourbon, which was originally, we should note, removed from a previous list, now seems to be back on as a potential target. We should note about 95% of the world's bourbon is produced in Kentucky, so maybe going after a state that is firmly in the Trump camp and is red. All of this needs to be watched as these negotiations take place. There's one key item in here from this reporting from our colleagues out of Brussels, which is the fact that they do want to make a deal. This is just in case the talks do not work out, and they have to consult all their members, a part of the European Union, by June 10th. So that is a new calendar date that we need to watch when it comes to how these talks will progress between Brussels and Washington.
Annmarie, there's a hierarchy of priorities. There is a list. I just wonder, let's go through the line. Apparently at the front of the line is the UK, and we're going to see that play out in 2 hours' time. I've heard lots about Japan. I've heard about India. I've heard about Korea. Where does the EU fit in?
Well, they're closer to the bottom than I would say closer to the top, potentially because those talks are going to be kicking off in earnest this week. They will move up on the priority list. But at the moment, they haven't been the priority for this administration. And we have seen this administration have a ton of grievances when it comes to the European Union writ large, especially when it comes to things like autos, comes to things like agriculture, which I'll be speaking to Brooke Rowland, the agricultural secretary, in about 30 minutes' time. We could talk about all of these issues when it comes to Midwest agricultural producers getting their products to the European Union, to the United Kingdom. So really, when it comes to the European Union, they might be one of the last countries, states, blocs to ink an agreement with the United States because they haven't been a priority. The United Kingdom is a priority. We know Treasury Secretary Scott Bessent's going to Switzerland, not just for those talks with the Chinese. He will also be meeting with the Swiss president. India, Israel, South Korea, Japan, they're all ahead of Brussels.
Annmarie with the latest reporting down in Washington, D.C. and more from Annmarie in just a moment, in about 25 minutes' time. The EU is not at the top of the list, and that's not good for those countries.
Part of the problem, and we saw this when we were in Washington, D.C. for the IMF meetings, is that Europe says that it's negotiating as a bloc from Brussels. It's clear that that's not exactly the case. So for people putting their faith in the euro as being the reserve currency and Europe being the generator of growth as a result of stimulus, this is the ultimate challenge. They are different countries with competing interests that are not really coming to the table in the same kind of way to understand what the priorities are on the other side.
Spain.
I knew you were going there.
Spain.
Yeah.
Where did the Prime Minister go? China.
Right.
What did they say? They said to us directly, they consider China an ally. They used the word ally to describe the relationship with China.
How do you get an entire trading bloc to get to some sort of agreement about how much they will restrict goods, say, to China or from China at a time when each country cannot come up with some sort of cohesive set of rules? This is the challenge for a region that otherwise has traditionally been very much an ally of the United States.
The first huge benefit, I would say, for the UK, depending on what this looks like, and of course it's got to go through Parliament and all of that, but the first big benefit of being outside of the EU for the UK, just being able to negotiate directly in the way that they have done, and they've played it pretty well so far, and I don't know what this deal looks like, or the framework for an agreement further down the road, but so far, played it quite well.
The mood music has been very positive, and Keir Starmer has definitely remained off the firing block, or the chopping block, when it comes to some of of the discussion points. Again, it goes back to how much of a template is this really?
Equities right now positive by 0.9%. We've snapped a two-day decline in yesterday's session. We add to the rally this morning. Darrell Cronk of Wells Fargo is writing this. We do see potential for broader risk opportunities and higher US equity prices by year-end 2025. Darrell joins us now for more. Darrell, good morning.
Good morning, John.
Talk to me about that confidence. What underpins it for you?
Well, I think certainly if we can get some tariff relief, let's admit it's an if, right? But what you're seeing now, so we got a 9-day rally on the S&P off of just a willingness by the administration to start to negotiate and roll back some tariffs. If we can shift that willingness to an actual ability, right, to deliver on some of these agreements, i.e. UK, maybe India, maybe Japan, maybe South Korea, I think that can move the level of confidence higher and by extension, equity markets higher. I would just note two things, right? One is, obviously and most of our watchers or viewers know that earnings are coming in, far better than expected, right? Revenue is on pace right now for a 5% increase. Earnings are tracking to 12 to 13% increase with a 85% in. And it's also noteworthy when you look at the equity markets. So on Liberation Day, you know where the VIX closed? 21.5. You know where the VIX is today? 22.5, right? We're right back where we were, almost like we've unwound that whole thing. So even though the survey sentiment confidence has taken a dip, and you need to pay attention to that, the reality is positioning has not changed. If you look at the CFTC data and stuff, institutional positioning has not run for the exits on the equity markets or any of that stuff. So I think you can base off of here, again, if you can get some relative good news.
You've been consistent. You think US assets can perform. You've remained committed to that story at a time when a lot of people have said, look over at Europe, take a look at China, look at the rest of the world. Maybe that exceptional story is over. Why have you remained committed to it?
Well, a couple things. One is we do think the growth, the technology, the superior markets are here, right, and have been for some time. Two, I mean, let's just be honest, we've been wrong in the first quarter. If you want to mark it off in the first 3 to 4 months of the year, obviously Europe has outperformed and developed equities as well as EM has outperformed. But we think that's a relatively short window. I went back and looked. If you look at the last 7 times that international has outperformed US, it's done it for a period of about 180 to 250 days. And then consistently it just rolls off, right? So there's kind of this euphoria, right, that comes up. And everybody gets a little excited about either cheap valuations or some news like, Germany's going to spend more on defense and everything. And then we just have the conversation like you guys just had at the table where, it's a non-configured group that can't get their act together. Is Brussels going to negotiate for the whole? Is the UK going to do their own thing? So I still think the balance of power and trade remains here. I'm not moving away from kind of the U.S. exceptionalism argument like many were quick to do. It may moderate a little bit on a relative basis, but I don't think it's dead by any means.
There has been a shift, though, in the conversation that U.S. exceptionalism is expressed in the equity market, not in the bond market, not by this de facto sort of investment in treasuries. And that's what we heard from Nouriel Roubini, that there will be still this steady flow into the U.S. equity market and the idea of tech dominance, not necessarily into the bond market. That's what we're hearing from investment managers who are looking elsewhere, whether it's Stephen Major of HSBC or Bob Michael, where they're looking internationally for duration. Do you think that this is only applicable to the equity market and that the bond market kind of takes on a life of its own?
I do think that's probably true, right? The bond market takes life on it. The way I would maybe describe it is if you think about the confluence of things that matter, the bond market and the dollar matter far more today, as we sit here today, than the equity market and the economy, right? I would clearly say that because at the moment you get disruption in either the bond market, right, rates start to get disorderly, or certainly the currency starts to devalue too much, people pay attention, right? Secretary of Treasury pays attention, the administration pays attention, call it the Trump put, call it whatever you want to call it. The reality is those elements of the bond market and the currency matter more today than what the stock market and the economy does in the short term, right? We need to see stability there. We need to see consistency there. We need to see kind of clarity of where we're going in those markets. So I think they are on a little bit of a different trajectory, Lisa.
Well, I guess that it sort of begs the question, how much is this idea that U.S. risk assets can continue to rally predicated on the idea that there is this best and put on volatility in the bond market, the idea that he will remain the front man, as we have seen so far?
Yeah, I think they will. I mean, so the reality is this. We were talking offset that if you look at even the Fed meeting yesterday and what's happening, there was a head nod and acknowledgement that the balance of risks are more even today between growth and inflation. But the reality is we have to admit the materiality of risks have gone up pretty substantially since several months ago. And so if the Fed is wrong on this, or if the bond market does start to have disorderly behavior or liquidity type moments, I think you'll get the administration to pay attention, and I think that's what is the attention grabber at the moment in time.
What do you think disorderly is? What did we see in April? What was that?
April was a little bit disorderly. It was probably more disorderly in places like the municipal bond market, right, where spreads really gapped out, but that tends to be more of a retail market, all else equal, than it does an institutional market. The Treasury market, I think you end up with just quick backups in rates, right? So we saw in early April where, the 10-year went from basically, call it sub 4, very quickly back to almost 4.5%, right? It's not necessarily always the rate movement in basis points, it's how fast it moves.
And it was the dollar move that accompanied that spooked people.
That's right.
Do you think we've addressed all of that? You talked about where we were on April 2nd and what's changed. A lot of things have remained the same, with the exception of maybe, I think you said gold earlier this week, gold being one, and the dollar being the other.
Yeah.
What's going on there with FX specifically, and why hasn't that corrected in quite the same way?
Well, I think it is a little telling that you're not getting any kind of a dollar bounce here, of any materiality. The dollar, if you looked at, to your point, the two things that are probably most oversold and overbought are overbought being gold, oversold or the dollar, in our opinion, right? I would expect the dollar to probably bounce here a little bit, just in a reversion kind of to the mean, but we'll see. I think it is telling when you think about, go back again to Chair Powell's conference yesterday, which matters more, growth or inflation, the markets are clearly telling you growth matters more, right? I mean, look at the 2-year Treasury, at 3.82 this morning versus a Fed funds of 4.33. It's screaming at the Fed to cut rates, right? Look at small caps continue to lag large caps. Look at oil prices, right? Oil prices are symbiotic of growth.
Yeah.
Look at copper prices. Like the markets are telling you growth is more of their concern right now than inflation. Now that could shift. Markets can be, can be fickle on you, but today there's no question that they're pounding the table, and the dollar is in that mix too, right? A weak dollar is telling you that growth is a concern right now.
We're in two different worlds. It just feels like at the moment, not just the soft data versus the hard data, but look at consumer expectations on things like inflation, screaming things are terrible. Things have been bad for a while for consumers, particularly at the low end, low income consumers. What you're seeing in the bond market, Lisa, is just saying something completely different. It's just saying, you know what, inflation-based expectations in the bond market at least, not really a problem.
We can see that with the break-evens as well, which is the reason why a lot of people have been dismissing some of the survey data, in particular the University of Michigan survey data. That said, we haven't yet seen the real economy response, and we are hearing about companies raising prices. This is the difficulty in a slow-moving economy and fast-moving truths and tweets and other types of social media output that causes our feelings to change from moment to moment.
We've had a few this morning already, haven't we? Including on Chairman Powell. Lisa's decided that the president's being nice to the chairman now. Is this playing nice?
Okay.
He said, he basically said he's a nice guy. Yeah, he's a fool,
it's
but...
the stuff before that.
Yeah, but other than that, other than that, Mrs.
I mean, certainly the Fed has to, or is independent of politics, but they're not independent of political policy, right? Trade, fiscal, regulatory, like all that stuff matters. So there's a tight connection there that you don't have to be, the Fed's independent of the politics, but it has to adjust to policy.
Darrell, it's good to see you.
You too, John.
Always is. Thank you,
Thanks,
sir.
Lisa.
Darrell Cronk there of Wells Fargo. Equities at the moment on the S&P up by 0.9%. The opening bell 1 hour and 15 minutes away. Then after that, 30 minutes later, all eyes on the Oval Office when we get that announcement from the UK and the US. With an update on stories elsewhere this morning with your Bloomberg brief, here's Yahira. Hey, Yahira.
Hi, John. The EU is planning to hit $108 billion of U.S. exports with additional tariffs if no progress is made in trade talks. The levies would target industrial goods, including Boeing planes and U.S.-made cars and bourbon. European Commission President Ursula von der Leyen saying the EU remains fully committed to finding negotiated outcomes with the U.S. And sticking on trade, President Trump is preparing to make his first trade announcement this morning. The president posting on Truth Social the agreement with the United Kingdom is a full and comprehensive one. More details are expected at a White House press conference at 10 a.m. And a check on Warner Brothers Discovery shares. They are down 1.5% in the pre-market after the media giant reported first quarter earnings. Revenue came in below the average analyst estimate, but in a bright spot, the company said it had 122 million streaming customers in the first quarter, an increase of over 5 million from last year. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira later on this hour. Up next on the programme, the Morning Calls Plus, Gil Luria of D.A. Davidson as Apple considers moving to AI search. A conversation up next. Equities on the S&P 500 positive by 0.9%. Much of this has nothing to do with the Federal Reserve. An assist from the President of the United States. An assist on a report that maybe they'll lift some chip curbs. That's helping out Nvidia. Plus, an agreement set to be struck between the UK and the US to be announced in about 1 hour and 40 minutes time, which could set the tone for deal making going forward from here with other countries. On the Nasdaq, we're higher by 1.26%. That's the price action. Let's get you some morning calls. First up, Wedbush downgrading Uber to neutral, seeing limited upside due to a lack of near-term catalysts. The stock is up by 0.5%. Barclays raising its price target on Disney to 120, saying the company's guidance for this year should provide comfort to investors. And finally, Bank of America cutting its price target on ARM to 135, expecting sales growth to slow more than consensus. That stock is down this morning by close to 8%. Elsewhere this morning, Apple considering revamping the Safari web browser on its devices to focus on AI-powered search, potentially ending its long-term partnership with Google. Joining us now, Gil Luria of D.A. Davidson. Gil, welcome to the program, sir. When you heard that statement yesterday, I just want your initial reaction. What did you think?
That it's the beginning of the end for Google search. We've known for a while that something like this could happen. Let's not forget the Department of Justice has brought up specifically the exclusivity of Google search on Safari browsers as a reason for concern and in part of their attempt to break up Google's monopoly. So the fact that now it looks like Apple is going to move forward in eliminating that exclusivity means that Google is going to lose its biggest platform on the iPhones. And at some point, that may happen on other platforms as well. Let's not forget the Department of Justice isn't done. They want Google to spin off Chrome. They want Google to spin off Android. So Google needs to start thinking of its search business differently. And that hit, even though investors were aware of that, it hit them pretty hard yesterday.
Yeah, we saw the second largest non-earnings drop in Alphabet shares yesterday, going back to 2020. Gil, are you saying that there's a lot more to come just simply because this is, as you said, the beginning of the end for their main business model, which is advertising tied to search?
Yes, because in terms of the financial results, we haven't seen anything yet on the search, because this hasn't happened yet. Only after Apple opens up search on Safari, only as people use chat more instead of search, right? People are now saying, I chat GPT this, not I Googled this. As those things happen more, all of a sudden there'll be alternatives to Google search. Right now, if you're a digital advertiser, part of your budget is going to Google search and you don't really think about it very much. There is a day in the future where there's so much activity on, say, ChatGPT, and ChatGPT is open to ads, where all of a sudden that Google search budget is going to get cut two ways. At that point, when that happens, and that's still somewhat down the line, when that happens, there's going to be a significant impact on Google's results. Until then, we won't see it, which is what's been confusing for investors. But when that happens, that's a cliff.
It's also confusing to investors that we're getting a lot of noise around trade deals or potential restrictions to sales overseas. And we're seeing NVIDIA shares pop significantly yesterday and on today. Again, Google shares today up a bit. And I wonder how much it's tied to this idea that the diffusion law that was put into place, the diffusion restrictions under former President Biden, which reduced sales to other allies, not just China, in order to restrict some of the exports of complicated chips, is being taken away. How do you understand that in the mix of all of this?
Yeah, so by the way, this is separate from tariffs. It may be a little getting a little muddied, but really this is a separate topic. What happened is NVIDIA chips were sold into China, degraded chips front door. The most cutting edge chips were sold into China by NVIDIA resellers. And so China was able to stay competitive in AI in spite of the fact that they're a competitor and an adversary. The Biden administration decided that's not okay and suggested the diffusion rules, which were going to come into effect next week. Those were restrictive on a large series of countries beyond China, including close allies like India, UAE, and Israel. And we now know, or we have reason to believe, those are not going to move forward, which is interesting, but doesn't solve the main problem, which is what is going to be the situation with China. Two separate questions. What chips, if any, will be allowed to be sold into China? And then what chips, if any, are going to be allowed to sold into Chinese companies, ByteDance, Tencent, Alibaba? We don't know the answers to those. But we do know that NVIDIA just took a really big write-down on those degraded chips. So we know there's something that's going to be announced as early as today, maybe over the next few days, about what chips can be sold into China. And that is by far the more important question. Sales into China are an order of magnitude higher than sales really into any other country combined outside the US. So that's really the important question. India buys tens of thousands of GPUs, UAE, Israel, probably in that order of magnitude. There have been millions of NVIDIA GPUs sold into China. So that is the question that we still don't know the answer to, but we will find out soon.
Hey, Gil, appreciate your take. We'll build on it soon with you. Gil Luria there of DA Davidson. I've got a third question, an extra one. How much does China need these chips, and how much has that changed in the last 12 months?
Given the fact that Jensen Huang said that they are very close in terms of competition and technological development to the United States, have they basically gotten what they need and then some?
Things seem to have changed a lot. Coming up in just a moment, we'll get you some breaking jobless claims and we'll get reaction from the team. We'll catch up with Nela Richardson in just a moment and Mike Collins of PGIM. Going into that, equity futures on the S&P 500 positive by 0.9%, a lift in this equity market. Going into that data just moments away. Economic data in just a moment. The focus is jobless claims after jobless claims pumped higher last week, which is not what you want to see. Will that trend continue? Will that be the start of a trend through the summer? We all hope not. Equity futures on the S&P 500 going into that positive by 0.9%, 1 hour and 30 minutes away from hearing from the President of the United States in the Oval Office unveiling an agreement on trade between the UK and the United States. The claims number for last week was 241. The estimate this morning is 230. The hope is that continues to decrease, not increase, because that would be a big red flag for a lot of you. The number this morning, 228. It's the right kind of downside surprise. The previous read, 241. Lisa, the estimate, 230. We wanted something in line. This one, just about below that number.
Yeah, and actually you did see continuing claims come in slightly below expectations, came down a bit from the prior week to 1.88 million rounded up. But this really raises the question, are we seeing the deterioration yet? No. Then if we're not, how can anybody respond to it, which goes into the wait and see, wait and see, wait that we heard yesterday about 25 times from Chair Jay Powell.
Yields are higher off the back of it, particularly at the front end. We unlock high yields again. We did that on Friday. after a better-than-expected payrolls report. Doing again this Thursday morning off the back of better-than-expected jobless claims, 382.83 on a 2-year. So at the front end of the curve, yields higher by 5 basis points. Had some commentary just going into this number from Andrew Honhorst of Citi. Waiting. What is the price of waiting? The chairman says there's a low cost. This is what Andrew has to say about it. Chairman Powell provided no new guidance at the FOMC meeting, repeating that the right strategy in the face of uncertainty is to wait and see. He described waiting as a low cost, but keeping rates at restrictive levels makes the economy soften, costing jobs that otherwise would have been created. Waiting now implies more aggressive rate cuts later.
To me, I could hear Neil Dutta scream at the screen and throw something when I heard Fed Chair Jay Powell say that the cost of waiting is very low and that they have the luxury of doing so. There is a feeling that there is an underlying strain of weakness that was already in the economy heading into this year, and that you're seeing signs of it, albeit at a slow pace. Look, this is the big debate. And as Darrell Cronk said, all of the potential outcomes are more extreme. And so the cost of waiting and seeing might be really great, but the cost of doing anything might be really great, given the fact that the range of outcomes has become that much more dramatic.
Unit labour costs pretty punchy for the first quarter as well. Preliminary read on that, 5.7%. The survey was looking for 5.1%. So we'll take that, won't we? Better unit labour costs.
I mean, that's essentially the argument right now, is that basically, yes, people are going to get wage increases, but they'll be more productive, and that will end up creating a better society where we can all go out and buy as many toys as we want to.
We'll talk about that productivity in just a moment. Nela Richardson of ADP joins us now for more. Nela, welcome to the programme. Resilience is something we've talked about with you a tremendous amount of times. I think you saw it on Friday in the payrolls report. Do you see some of that resilience again in the economic data, in the labour market data specifically?
There is. Hi, good morning. Yes, there is some resilience and quite a bit of resilience in the U.S. labor market. And you see that with this latest data on jobless claims going back down closer to that historical low. And so this is an economy that still pumps out jobs. We saw that last Friday in the jobs report. While the Fed is on hold, the economy certainly isn't, and businesses around the country continue to operate, produce jobs, consumers continue to spend. But the question is, what's going to happen in the future? And so this feeds into this wait and see attitude that's, hurtful for markets perhaps, but part of what Main Street is doing to keep going.
Everybody wants the forward look, the crystal ball. There are subtle signs now and again, here, there and everywhere. Nela, I go to the payrolls report on Friday, and you mentioned this. Typically, if companies were pulling back, they'd reduce the work week. Nela, did we see that on Friday?
No, we didn't see it. Hours are holding steady. They're holding strong, and we're not seeing in the ADP payroll data either. We pay 1 in 6 workers in the United States. We have a strong concentration in manufacturing. We're not seeing a pullback in hours. And so those first clues of a labor market that's fraying are not present. In fact, we're actually seeing for people who are switching jobs in the last year, in the last 3 months, that pay is going up, and they are more sensitive to real-time economic conditions. So there's not anything in the labor market yet that suggests a slowdown is coming. What we're seeing in the macro economy are risks, and that's where the costs come in. It's worth talking about what the Fed would like to do at the party, because a lot of people talk about the punch bowl and the Fed and their growth spurt role in the economy. But what the Fed prefers to be is a wallflower. They prefer to let the economy do its thing without having to provide that kind of stimulus. And right now, that's what you're seeing in the labor market.
So we also saw continuing claims come in a little bit, Nela. Does that rebut the idea that people are having a harder time finding a new job, even with the prospect of just a sort of wait and see, or as we heard from Jim Zelter, macro paralysis?
There's some of that. I've been concerned over the last couple of years about the lack of dynamism. That we've seen it in the data that there's been less turnover by companies, by workers. Now, part of that is the Great Resignation. There was a lot of turnover then, and maybe people have been settled into their current jobs. They've been there a couple, 2-3 years. They're not ready to make that switch. But this is a labor market that thrives on dynamism. And if people are, in some sense, in a wait and see mode, that dynamism won't spur the kind of productivity growth that ultimately keeps inflation down. So as we're looking at a pretty solid jobs market, we have to turn the page and look at productivity and make sure that that's starting to increase as well, because in general, the trend is that productivity growth is lower now than it was the pre-2000s. And so why is that? Well, right now, it looks like it's because some companies are stuck on pause, waiting for more clarity.
At the same time, Nela, we keep getting headlines like yesterday from CrowdStrike, the idea of layoffs pretty much across the board. This morning, Match Group cutting 13% of staff. There have been a number of pockets like this where we have seen some job cuts, particularly in the tech space, but some others as well. How do you put those indicators, these sort of anecdotes, into some sort of broader theme that you can get your head around?
Well, first of all, we have to be like grown-ups about the labor market, I think. There are companies that will make decisions to change their way of operations, change their investments, and some of them will lead to layoffs. And so that's the reality of the labor market. What we'd like to see, though, is that this continues to stay in pockets. It's not spreading into other parts of the real economy. And right now it is in pockets, and tech is particularly sensitive to this because it's an industry that thrives again on productivity, on growth, on taking those big bets, on making those big investments. Sometimes they don't work. What I will say, though, is that the overall macro economy doesn't help. And so that uncertainty makes it harder to stay the course on a big investment. And that might be what we are seeing. And so I guess the broader narrative would be, yes, tech has kind of always been its own special move fast, break things, innovate, and pivot. And so we should continue to expect that. But what is the greater, larger economy doing in response to the uncertainty? Right now, it looks like it's chugging along. Let's hope it continues.
Nela, we've got to leave it there. As always, good to get your input. Nela Richardson there of ADP. If you're just joining us, so the number we were looking for was jobless claims. That came in at 228. Previous number was 241. Estimate was 230, so that's better news. This equity market was trading on the prospect of a big deal between the UK and the United States. We'll get the details of that deal in about 1 hour and 22 minutes time from the Oval Office with the President. I can tell you equities have just pulled off session highs. A report here from CNN, no confirmation here at Bloomberg or directly from the administration. And as always, you should always wait for that. Wait to see what the President actually has to say about what's happening. But from CNN this morning, the US-UK trade pact will leave the 10% US tariff in place. And this, Lisa, is going to be the thing people try and get their hands around. Is this a template for what's going to happen elsewhere? And if that stays in place, is that the new normal? Are they the rules of the road?
That's exactly where I was going to go. If this does remain in place, can people just start to price in across the board at least 10% tariff as being the rules of the game going forward? Right now, I'm not seeing a huge pullback, as you mentioned, just a little bit off session highs, which is surprising to me, which highlights to me either people don't believe it, they haven't seen it, or maybe that's already been baked into some degree, that people sort of expect that 10% to be the floor across the board.
There are several buckets here, and we've talked about them all morning. You've got the tariffs on steel and aluminum. You've got the tariffs as well on autos too. So if there is an agreement, it'd be interesting to see what they are willing to pull back on, if anything at all, or whether this is just a template for something bigger further down the road. Stay tuned. All eyes on the Oval. 1 hour and 20 minutes away. Joining us now to discuss is Mike Collins of PGIM Fixed Income. Mike, we've got to talk about the data, the Federal Reserve, its reaction function, and the prospect of deal-making down in Washington, D.C. So let's start in the White House. Mike, what are you expecting to see from the President at 10 a.m. Eastern Time?
You know, I'm worried, Jonathan, that it's going to be a disappointing announcement, right? Obviously, the markets are kind of rallying this morning in anticipation of this big announcement and this big successful negotiation. But like the report you just indicated, I think it's going to be a real bumpy road on this whole tariff process, probably for most of the year. And this may be, you know, kind of the first salvo, and you know, it could be disappointing. So just be cautious on that front.
This is what the reporter from CNN has to say on this. that the trade announcement with the UK will be limited in scope, heavy on future commitments, and leave the existing 10% universal tariffs in place, according to a US and UK official. Now, Mike, if we do hear just that, almost verbatim, how would you expect the market to respond?
Yeah, negatively, right? I mean, it's just more of a continuation of this, like I said, really choppy process we've been going through. And I think ultimately it's bad for the economy. It's bad for the level of certainty that companies have, that consumers have in terms of investing and spending on big ticket items in the economy. So, I think we're still kind of moving toward this stall speed in the economy, and this level of uncertainty I don't think is going to go away anytime soon.
Mike, if it's bad for the economy, is it good for bonds?
It really should be, right? I mean, we're really in a conundrum right now, and the Fed did a really good job yesterday explaining the conundrum, right? I mean, you look at what's priced in right now, Jonathan, right? There are about 100 basis points of rate cuts priced in over the next year. Another way to think about that, though, is maybe there's a 50% chance of no cuts, which is where the Fed is right now. I mean, they are stuck. They are on ice. They really can't do anything potentially for most of the year. And then maybe there's a 50% chance of 200 basis points of rate cuts, right? And it feels like that's the dilemma in the markets, right? It's, as Tom Porcelli told you yesterday, it's really a coin flip on whether or not we have a mild moderation in growth or a deeper growth dilemma. You are seeing a lot of, as you just mentioned, anecdotal layoffs, and they seem to be accelerating over the last weeks. And, the jobs numbers and those unemployment claims we just got are kind of lagging indicators, right? I mean, they really, once they start moving in the wrong direction quickly, you're already in the throes of a recession.
Mike, the last time we spoke after Liberation Day, you talked about how there was a shift in your view about the reaction function, if you will, of bonds, and whether that was going to be the haven play in some sort of downturn, and that you have seen some sort of shift away from international buying of the U.S. Dollar, but also of treasuries in general. Do you feel like if there are trade deals, that could change back to just simply weighing the economic risks and seeing bonds as a good investment in the face of weakness?
Yeah, for sure. I mean, Lisa, Robert Tipp, my colleague, taught me 35 years ago when I was starting in the business that the 30-year Treasury is an insurance policy, right? You buy it, you get paid to own it, and if things go south, you can make a lot of money, right? And I really believe that the markets are set up for that, right? I mean, Powell even indicated he has a lot of capacity to support the economy, meaning those 200 basis points of rate cuts that maybe there's a 50% chance of that price in the market, that could come to fruition pretty easily. And yeah, I know that the talk right now, the narrative is the yield curve would just steepen a lot. The front end would do well and the back end wouldn't. But if the Fed is cutting 200, 250, 300 basis points, the whole curve comes crashing down, right? Yeah, it steepens, but it has already steepened a lot. I mean, there's a 100 basis point spread right now between twos and bonds, and the 10-year is right in the middle of that. And yeah, so it steepens. We're in that, ready for that type of move, but there's a lot of cuts priced in the near term. That probably won't come to fruition. But yeah, I think bonds will be the ballast in your portfolio.
Mike, got some more reporting, so I want to get to that. So stay tuned. Stay tuned for 10 a.m. in the Oval Office when you hear directly from the President of the United States. But we've got various reports going into that. Everyone is working very hard to try and get ahead of this. So this came from CNN initially, reporting that the US-UK trade pact will leave the 10% US tariff in place. As we've discussed on this programme all morning, there are other tariffs in place on steel, aluminum and autos. The Financial Times reporting here, Lisa, the UK officials see the US deal initially focused on autos, on steel. Now, this is from the Financial Times. We don't know what it's going to look like at 10 a.m. Eastern Time. And as I often repeat, you have to hear it from the president directly. But Lisa, that's the latest.
And there aren't necessarily the complications of the reciprocal tariffs on the United Kingdom. So if this is a true test of what the sectoral tariffs could look like on a country-by-country basis, that maybe is a template to follow, that there is going to be an all-in type of tariff rate rather than maybe specific tariff rates on different sectors. If you're confused, well, wait till tomorrow, because I'm sure it'll just be a lot clearer then.
I hope Mike Collins hasn't got anywhere, because I want to come back to Mike and ask him about this. Equities at the moment still positive by 0.6%. Mike, I want to talk about credit with you on a sector basis. How many of these sectors are investable right now, based on the fact that the president can just flick a switch on and off and make them uninvestable or investable at any given time?
Yeah, so the job of a credit analyst is really difficult right now. But that being said, we do know generally the sectors that are at risk, right? Some of those big kind of industrial sectors, the manufacturing sector, sectors like autos, where they do import a significant percentage of their supplies and vehicles. And we've done a great job. I listen to our credit calls every morning, Jonathan, and they typically go like this. Well, we're really worried about this sector. They're struggling. Their margins are coming down, but we're underweight. We're avoiding it. We've seen the writing on the wall. So I think there's actually a real advantage to having a lot of boots on the ground in this type of environment. And it's difficult to predict the final outcome, but there are definitely clues which sectors are more at risk versus others.
Mike Collins, appreciate the update. Mike Collins there of PGIM Fixed Income, as we all work through these headlines to try and get a better picture, Lisa, of what we might see in 1 hour and 40 minutes' time.
Which gives you a sense of just how much people are hinging on just a select group of deal makers to come together and give some guidance. It is interesting that markets aren't trading more on this, because I guess people don't know either what to make of it, or is this basically the market saying that they could live with 10% of a baseline tariffs as long as there is an evening out and a dropping of some of the other potential levies?
This would be fantastic news for Jaguar Land Rover and some of the auto companies in the UK, that's for sure. We said this a few times on this programme already this morning. And as I've said on repeat, wait for the president. The president speaks in 1 hour and 15 minutes' time. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Yahara. Hey, Yahara.
Hi, John. Recapping the latest economic data, U.S. jobless claims fell last week to 228,000, roughly in line with estimates. The drop comes after a short-term spike at the end of April, coinciding with spring recesses and the Easter holiday. Continuing claims also fell. Meanwhile, the wait for the next pope will continue after black smoke poured out from the Sistine Chapel chimney once again. Cardinals failed to reach an agreement earlier this morning after 2 new rounds of voting. 2 more rounds will happen later today. And the FAA will announce a plan to overhaul the U.S. air traffic control system later today. Transportation Secretary Sean Duffy is expected to outline a series of upgrades to staffing, facilities, and equipment, and convene a panel of airlines to discuss reducing delays at Newark Airport, which was hit by a 90-second technology failure last week, leading to days of disruptions. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll set you up for the day ahead, and it could be a very busy one. At 10 a.m. Eastern Time, the President of the United States in the Oval Office unveiling what could be a big announcement regarding trade between the UK and the United States. A sneak peek, perhaps, of some of the details up next. The opening bounce 38 minutes away, and equities are positive by 0.8% on the S&P 500. On the Nasdaq, up by 1.2. With your movers going into the cash open, here's Danny Berger. Hey, Danny.
Hey, John. Some more earnings from you. We heard from Match Group. The thing the markets are concentrating, though, is on their ability and their effort to turn things around. They have a new CEO. They're under pressure from Elliott Management. They announced that they would let go 13% of staff and about 1 in 5 employees and managers there. So we are seeing shares a little change this morning. They are coming down from a higher result. We also got earnings this morning from Peloton, trading to the downside. It also has a new CEO, also trying to engineer a turnaround to look more like COVID levels, but recorded 3 straight quarters of losses. Those shares down 8%. Also noted that it would face a tariff of 25% on the aluminum in its parts. Finally, here's something you don't hear often from consumer discretionary companies: a beat and a raise to the outlook for Tapestry. Really strong results for their Coach brand, up 13%. The company saying, look, we don't have much exposure at all to tariffs. Citi also noting that of the things it imports, only about 3% come from China. So those shares up 9% in the pre-market, John.
Danny, thank you. Thanks for this morning. 3 names to watch into the opening bell. Plenty to watch into the weekend and into next week. At 10 a.m. Eastern Time, you will hear from the President of the United States making a trade announcement in the Oval Office. Into the weekend, US and China trade talks kicking off in Switzerland. Into next week, CPI data on Tuesday. Plus, the President heading to Riyadh for the first stop of his Middle East trip. On Thursday, PPI retail sales and another round of claims, plus earnings from Walmart. Big earnings report from them coming right up. As we look ahead to 10 a.m. Eastern Time, joining us now from the White House is Annmarie. Annmarie, what can we expect? What are we looking for in 1 hour's time?
Well, what we look for when it comes to this U.S.-UK trade agreement is the start of a more fuller negotiation for a trade pact. Two key items. One, when it comes to UK imports coming into the United States, the UK has been pushing for that 25% tariff level on steel, aluminum, and cars, that to be reduced. Likely we're going to see that. And then when it comes to U.S. products going into the UK, like agricultural sector, maybe cars as well, a key focus for this administration, potentially you would see the UK also drop those tariff rates, as well as something that has been a thorn of the side of big tech companies for years, the digital services tax. We should note this is the first of an agreement that the president has been talking about. It's a big one for him. We should, though, say when it comes to the UK and the US, Jonathan, you've been saying all morning, trade is relatively balanced between these two countries. Actually, the UK has more imports into the United States. So I would say that this is one of the more easier negotiations the president has been able to have when it comes to things like the European Union or China. It's going to be a lot harder.
Annmarie, you run away. You try and get in the Oval Office and ask some questions. Annmarie, thank you.
I'll be there.
Down in Washington, D.C. Appreciate it. Big conversation coming up in about an hour's time.
Yeah, at a time when a lot of people are trying to focus on front-running this and getting a sense of exactly what the contours of this will be. What we're hearing from CNN is that 10% baseline tariff is going to be remaining in place. And the Financial Times saying that will have to do with steel and auto exports from the UK and what kind of tariffs could be on those. I wonder how open this suggests the administration would be, if this is true, to potentially lowering them on a more across-the-board basis, or whether this is going to be one of the chips used to possibly get a deal on the other side for other people, too, on a case-by-case basis.
It's been a busy morning, hasn't it?
Indeed.
More still to come. The Oval Office address about 1 hour and 5 minutes away, a press conference with the President of the United States on a trade agreement, whatever that looks like, between the United States and the UK. Coming up tomorrow to react, Max Kettner of HSBC, Alex Altman of Barclays, Alicia Levine of BNY Wealth, and Tiffany Waldig of PIMCO. From New York, thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
Welcome back to a special Italian Open update for Bloomberg TV and radio from Tennis Channel. Former world number one Naomi Osaka won her first career clay court title last week, and the four-time major champ is now on a 6-match win streak after she took out Sara Errani in style. Osaka moving on to face the number 9 seed, Paula Badosa. And don't forget, you can watch all the action live daily on Tennis Channel.